markets remain relatively buoyant and hopeful.
That bounce back that you have is warranted.
We're clearly pricing out a lot of the tail risk.
The stock market has been the most accurate indicator of where the economy is going.
If you're looking 6 months out, I still think we're higher than where we are here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday at all-time highs. A record-breaking chip surge powering the U.S. stock market rally as capital expenditures at Tesla is set to exceed $25 billion. The tech boom insulating equities from a prolonged crisis in the Middle East. Crude back in triple digits.
And really that's framed perfectly because on one hand you have this huge face-off in markets of oil prices on the one hand, and then on the other the AI hopes and dreams that are coming through in a lot of the earnings. You can see, for example, chip stocks. 16 straight day of gains, which is the longest run ever in history. That index is on pace for its biggest monthly gain going back to 2000. At the same time that, yes, you're seeing record highs with incredibly narrow breadth because of all of what we're seeing under the hood tied to oil prices. How much is this rally being kept down, frankly, even though people say we can just hit more records again and again and again?
Look at what companies are doing. Let's pick three. Let's go with Tesla, tripling CapEx for the year ahead. That's them. Texas Instruments raising their outlook, strong guide from them, strong forecast. GE Vernova, they make the big nat gas turbines for the big data centers. Their order book at the electrification unit was bigger last quarter than all of last year, which speaks to the tech boom we're seeing right now in this country.
Those three companies perfectly exemplify what's going on right now because you saw Texas Instruments and GE Vernova both shoot to the moon, right? You saw a complete welcoming of those results because they showed how much they're winning from the tech investments. Tesla, another story. They came out, they beat expectations, but it turns out they're not a car company. They're using their car revenues to fuel all of the autonomous driving as well as the robotics that they have in place. And the CapEx is actually causing some skepticism around the share. So is this sort of a template for what's to come for the big tech players that report next week?
This is the tension, it's the tug of war between two different time horizons. The future, a positive one for US tech, got all of that. The present, pretty dire over in the Middle East. The confidence seems to be around the idea that the president is committed to de-escalation, that this won't be a prolonged supply issue, it will be a transient shock. And then you see this from the Washington Post. This story right here. It could take 6 months to fully clear the Strait of Hormuz of mines deployed by the Iranian military.
What does reopening the strait entail? What does it mean? How close are we? And what is open enough to comfort the market that there will be enough supply to actually keep this economy going? There is a complete disconnect between the people who we speak to in the physical world and the people who we speak to in the theoretical world who have a lot more hope. What you can see, though, in the prediction markets is people are ratcheting back their expectations for when there's an all clear in the Middle East. It's getting harder to see when that could actually happen. And again, the time horizon of when this creates economic damage continues to be in focus, and people keep kicking the can down the road in terms of what they say really will be pernicious.
Welcome back. I should have started with that.
Thank you.
You caught up with Scott Kirby of United Airlines yesterday. Big question for all of us. Is summer cancelled or not? What's happening with flights and how much are they going to cost?
What he said is the transatlantic flights will be prioritized. And before you start to not be able to go to the south of Italy, they will cancel all of the regional flights in Europe in order to prioritize that corridor and all of the international flights. That said, there is going to be constraint, and that is what you can see. He's looking for it at it as an opportunity to potentially pick up assets. But what that indicates is there's severe pain, and we're hearing about government bailouts again for the airlines at a time of real distress.
Uncomfortable choices, uncomfortable trade-offs, and the data in Europe uncomfortably bad throughout this morning so far. Equity futures stateside on the S&P 500 negative by 0.5%, pulling back slightly from all-time highs. Coming up this hour, we'll catch up with Keith Lerner of Truist with stocks pulling back from those records. Victoria Coates of the Heritage Foundation with the US and Iran deadlocked, and Paul Sankey of Sankey Research with crude back in triple digits. We begin this hour with our top story. The US calling on Iran to restart peace talks. Bloomberg's Jemana Besetchi leading our coverage out of the region and joins us now for more. Jemana, are we any closer to those talks?
It doesn't appear to be the case, John. And, yesterday, once again, the White House reiterating that they're waiting to hear from Tehran on their version of a new peace proposal. It hasn't come through. And what we have got instead is a post, once again, from the Iranian president overnight, Masoud Pezeshkian, saying they do want to return back to dialogue, but a breach of commitments, the blockade and threats are the main obstacles to genuine negotiations. And here, once again, referring to the fact that as long as the U.S. naval blockade remains in place, they will not be returning back to the negotiation table. That is the stance that they have consistently been portraying over the last couple of days. And it seems very unlikely at this point that we're going to get another round of diplomatic discussions, despite the mediator's best efforts. So the attention in the last 24 hours has really shifted to what has been happening around the Strait of Hormuz, because there is an impasse there, but that's not to say that it's safe or uneventful. In fact, there have been several incidents in the last 24 hours, pretty dangerous. The UK Navy reporting that 2 ships were fired on. IRGC then seized a couple of vessels as well. The US, their part, caused a made 2 Iranian they were laden with oil vessels turn around, and CENTCOM releasing an update this morning suggesting that they have caused 31 vessels to change routes over the course of this blockade that has been going on for more than a week now. And so what you have here is obviously a battle of the Strait, but essentially a battle of wills, because the question here is timing. Iran's calculation is that the longer this goes on for, the more you're going to see uplift on the price of oil. Eventually, that's going to feed back to the U.S. consumer. It's going to test President Trump's patience and bring him to the table for another round of negotiations, or at least to wind up this war quickly. The U.S.'s calculus is that the longer this goes on for, the more you're going to start eliciting a lot of pain on the Iranian economy. President Trump is saying that it's costing them $500 million a day. We haven't been able to verify those numbers, but the point is, it is a battle of wills alongside the battle of the Straits. And we've got to see whether either or both sides will be willing to lift the blockade in order to move to a next round of negotiations. The alternative, though, is still a resumption of hostilities. So that's still a possibility.
A high-stakes, potentially lethal blinking contest taking place right now. Jumana, thank you. Jumana Basechi out of Dubai this morning. Crude, Brent, for a 4th consecutive day, 103.80 so far this morning. That's the situation in the Middle East. This is the view on Wall Street this morning. Keith Lerner of Truist writing, the weight of the evidence continues to suggest that the bull market deserves the benefit of the doubt, and we would view weakness as an opportunity. Keith joins us now for more. Keith, welcome to the programme. I've got 2 whys. Why do you believe the bull market deserves the benefit of the doubt? Why do you think that a weakness is an opportunity?
Yeah, well, great to be with you all. Well, the first thing is I think the bull market has earned it. This bull market has been battle-tested through a series of shocks, from high inflation to fast-paced interest rates. And each time, these companies have adapted, and we're seeing profit margins continue to expand, and we're seeing forward earning estimates at new highs, not only in the S&P, but also by by mid caps, small caps, and even emerging markets as well. So listen, I don't want to be Pollyannish either, Jonathan. I think there is some uncertainty. We just had a nice rally off the low, so it would be perfectly normal to see some backing and filling after this. But the last point is, we also know, I think there's so much focus on Iran and the situation there, which is important. But let's not lose sight of the dominant theme of this bull market, which you all talked about, is AI and tech. And that story is likely not changing. In some ways, it looks like it's actually accelerating.
Keith, 16 days. Lisa mentioned it. 16 days of gains for the Philadelphia Semiconductor Index. A powerful rally. One of the best months we've seen, by the way, in about 25 years for that particular index. Keith, when you look at those moves, and when I look at where we bottomed, do you think we still underappreciate the relationship between this rally and, say, Mythos and Anthropic? And perhaps we're looking too much towards de-escalation and what's been developing in the Middle East?
Yeah, I do. And, when we were selling off in March, we were highlighting the technology that, the valuations got to a 20 PE, which was lower than the terrorist shock of last year. And the premium relative to the market shrunk to the lowest level in over a decade. And one thing we just looked at, Jonathan, I thought was really interesting. We looked at the peak to trough change in the valuation, or the compression of the valuation for the tech sector, over the last several months. It was 37%. We went from a 32 PE to 20. When we look back to this decade, that's the most severe compression we've seen out of any of the pullbacks, more than COVID, more than the terrorist shock. And you can argue that there was actually more uncertainty in some of these other areas as well. So I think we've reset pretty well. The earnings momentum by far is the strongest in the market. The forward earning estimates are being revised higher over the last 3 months by almost 20%. That's about double the S&P. So I think all in all, kind of this tech story moved to the back burner. Now it's moving towards the forefront again. And again, after this big move, are we going to pull back a little bit? Maybe. But last point on tech is it just moved above the October high. So since the October high, we're up 0.2%. So ultimately, I think this bull market and tech has further to go.
Where in tech, though, Keith? And this is a big question mark underpinning this rally, given the fact that right now the picks and shovels of tech seem to be rallying. We're seeing the semiconductors, we're seeing the memory chips, we're seeing the energy side of things, GE Vernova, with respect to some of the way that they're electrifying some of the data centers. Going forward, do you think that next week is going to be a gut check in terms of how the market responds to additional CapEx plans?
It likely will be, but I also think, as long as these earning estimates continue to get revised higher, I think the market will be okay if CapEx continues to be at a rapid pace. I don't think anyone's really expecting much of a pullback in CapEx, because really what's got the market's attention more recently is there's a lack of availability for GPUs, and as these models are becoming more powerful, the demand for that will only grow. So, listen, I don't think we're going to see a big change in the CapEx story. I think in some ways what we're seeing more recently in the power of these models is going to validate the expansion of that CapEx. I think more interesting we'll see what are we going to hear about the employment side, because we're actually starting to see a tick up in some of those announcements as far as displacement.
How do you treat that as an investor? I mean, I know that from a psychological perspective, that has a pretty big hit, and we're seeing that take place even in places like China. Some of the anecdotal information suggests that there's a real cramp down on employment as a result of AI. Is that a good thing as an investor because it reduces costs?
Yeah, longer term it is somewhat circular, because we do need people spending to move the economy forward. But I think there's different time frames on this, and I think in the short term, if you see profit margins continue to move up and you're seeing the sales per employee or cash flow per employee move up, I think ultimately the market will reward that. Now, again, there's probably a greater story to be told from an economic perspective, and we all know that. But I think in the near term, the market's going to focus on profits.
Hey, Keith, that's the focus right now, that's for sure. Thank you, sir. Keith Lerner there of Truist. Netflix just moments ago authorizing a buyback of additional $25 billion in shares. In a pre-market, that stock of raising losses now positive by around 1.7%. But look at the consumer. I'm pleased you brought up the labour market and the real economy. Hilton up by 10% this month. Chipotle up by 10% in April. Carver up by 20% this month. Some interesting things going on in the restaurant and hotel business as well. You've seen some rallies there, even with this move in energy.
Part of the reason why is just the resilience that you see in the consumer. You were talking to Holly O'Neill yesterday from Bank of America, highlighting just how robust things have been. Scott Kirby of United yesterday saying he's been surprised that there hasn't been demand destruction even as they raise prices. So clearly there is a consumer with money to spend. Where they're spending it, the winners and the losers definitely coming clear. Mediterranean evidently triumphing over, say, some other high-priced coffee.
Mike Dada published something recently that I think is going to resonate with you, because you've alluded to this a few times in the last 2 months. What if instead we have an underlying boom condition that has been partially suppressed by geopolitical turmoil and the energy shock?
That, I think, is what a lot of people are saying is actually happening. That you're seeing these upgrades to earnings that would be even bigger upgrades, that would have been a huge blowout type of quarter had it not been for what we're seeing over in the Middle East. And the resilience that you're seeing in the underlying economy and, frankly, the equity markets exemplifies that more than anything else. And I think that that is what people are coalescing around. And frankly, that is what record highs on the U.S. equity market speaks to.
Speaks to the data we've seen as well so far. ADP jobs data was pretty decent. Retail sales pretty strong. Jobless claims a few hours away. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. I'm pleased to say joining us now is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump saying the ceasefire will stay in effect indefinitely until Iran comes to the table with a new peace proposal. Iran saying it has no immediate plans to take part in negotiations. Iran's president posting on social media that the U.S. blockade and threats are the main obstacles to diplomacy. The U.S. military intercepted 2 Iranian oil supertankers that were attempting to evade its blockade. U.S. Central Command saying the 2 tankers are now anchored at an Iranian port in the Gulf of Oman. CENTCOM posting that the U.S. has directed 29 vessels to turn around or return to port since the blockade began. Tencent and Alibaba are in discussions to join a funding round for China's DeepSeek. Sources telling us here at Bloomberg, Tencent has proposed the acquisition of as much as a 20% stake in the startup, though DeepSeek isn't keen on ceding such a large portion of control. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie a little bit later in the programme. Up next, playing the waiting game.
The president has not set a firm deadline to receive an Iranian proposal. The United States maintains control over this situation, leverage over the Iranian regime. The cards are in President Trump's hands right now.
Up next, we'll catch up with Victoria Coates of the Heritage Foundation, live from New York City this morning. Good morning. Snapped the two-day losing streak on the S&P 500 in yesterday's session this morning, taking some of that back. We're down by 0.5% on the S&P, down by close to 0.6 on the Nasdaq 100. And the surveillance this morning playing the waiting game.
The president has not set a firm deadline to receive an Iranian proposal. Ultimately, the timeline will be dictated by the commander-in-chief and the president of the United States. The United States maintains control over this situation, leverage over the Iranian regime. Not only have they been significantly weakened and obliterated militarily, but they are losing economically and financially. The cards are in President Trump's hands right now.
So here's the latest this morning. Peace talks between the U.S. and Iran at a standstill. Iran saying it won't resume negotiations unless the U.S. ends its naval blockade. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, at this point, the standoff in the Strait of Hormuz is only worsening, threatening the potential timeline and prospects for a deal. New this morning, the U.S. military saying that it has intercepted two Iranian oil supertankers it says was trying to evade the U.S. naval blockade. And at this point so far this week, we've only seen Iran try to move to tighten its grip over the waterway and boost its negotiating leverage, as data shows us that the country is now moving its supertankers into the Arabian Sea. And yesterday, the IRGC came out and said that it seized these two vessels in retaliation for the U.S.'s efforts. Now, White House Press Secretary Caroline Leavitt went on there to say that the U.S. doesn't view these actions as violation of the ceasefire, in particular the fact that the two vessels that Iran seized were not American nor Israeli flagged, but it's just going to underscore the point of how dangerous the conditions in the Strait still remain, as a military assessment presented to Congress and reported on by the Washington Post is now estimating that it could take up to 6 months to clear 20 or more mines that Iran laid and deployed in the Strait of Hormuz. John, as you've been discussing on the program, this White House says that the timeline to reach a deal at this point is indefinite, that the U.S. wants to give Iranian leadership time to come together and present the U.S. a plan. But we are starting to learn a little bit more about how the president is thinking about the pressure of energy prices. Axios reporting earlier this week the president could extend the waiver he has issued on the Jones Act in a bid to help out the consumer.
Tyler Kendall with the latest. Tyler, thank you. There is a ceasefire. It's difficult to make the case that things are peaceful, particularly given the coverage we've heard from Tyler and Jemana already this morning, that the Iranians have been firing on vessels and seizing ships.
Yeah, I was reading about the damage done to an Indian ship that thought that it had clearance to go through and then didn't, and then ended up in Iranian waters. When you start talking about mines that are embedded in the Strait of Hormuz that might take 6 months to really detonate, highlights just how high the bar really is to reopen the strait in a way that we were used to, say, a couple months ago.
Let's build on this conversation. Victoria Coates, the former Deputy National Security Advisor to President Trump, writing the following: Iran has sustained such systematic damage that they really can't recover. Time is entirely on the president's side. Victoria joins us now for more. Victoria, welcome to the programme. We called this at the top of the programme a high-stakes blinking contest. Is Iran willing to risk regime collapse? And is the US willing to continue to put maximum pressure, assert maximum pressure on the Iranians and take the economic consequences that the global economy might have to take?
Well, good morning, Jonathan. I have to be careful what I write on my X feed because I never know what you're going to read back to me. But I stand by that. I stand by that comment. I think that, as we dive deeper into what's happening in the Iranian economy, and also the other piece of this is the fact that since they haven't been able to get product out of the Gulf since the blockade began, they're starting to fill up their storage on Kharg Island, and they're going to wind up at a point in a matter of days. They might have a week or 2 weeks, but I think it's a shorter period where they're going to have to start thinking about capping wells, and that's not a good thing. That could really do permanent damage to their oil reserves, and they have the second largest oil reserves on the planet. It's one of their great strengths. That's going to be a decision point for them. So I do think that the pressure that is building on the Iranians, I mean, they have to restart their economy. They need to turn their internet back on, their stock market back on, but most of all, they need to start being able to get product to market. So if these days go by, they're going to have to make that existential decision you describe and make a choice between economic collapse and potentially preserving the regime.
Victoria, do you have confidence that this is a logical kind of regime in Iran that the United States is dealing with in the matter of financial collapse being enough of a threat to really bring them to the table? And I ask this because so many people have come on this show and said their goal is simply survival.
Well, I would never call them rational, Alicia. I think that they are, right now, very cornered. You've had the decimation of the 40 top leaders in the first day of this action against them. And so they're still trying to recover from that. Nobody knows where the supreme leader is. He's been supreme leader, Campmany, for more than a month, and he hasn't even published a video greeting the Iranian people. Famously, he was a cardboard cutout at the announcement of his appointment. So, this is not in any way a stable, normal, functioning government. They also can't communicate. They're worried that the Israelis are in their cell phones, probably for pretty good reason, and so they're passing notes back and forth, and that's part of the delay in the negotiations. The president wants to make sure he has somebody with the authority to make those decisions at the table, and it's not clear that person has emerged yet.
One difficulty and one reason why a number of strategists have been really pessimistic is they don't see a path to an end that leaves the Strait of Hormuz open, free trade and commerce going through that, and the current regime in place. How do you see this playing out in a way that brings the Strait of Hormuz back to sort of the free flow of commerce that we were familiar with a couple of months ago?
Well, I don't think we're going to return to sort of business as usual in Iran. I don't think there's a universe in which the regime can reconstitute itself as it was. I would go back really to early December of last year and the kind of control it was able to exert over its people. And this will be a very fluid period. And I know that's disruptive and concerning for a lot of folks. But at the same time, the other thing that's happening to them is they've stopped being able to pay the salaries of their security apparatus, the IRGC, the Islamic Revolutionary Guard Corps, that's the key to their being able to control the country physically, is stopped paying its people, and their police are stopped being paid as well. So that's going to create some more disruption within Iran as the people of Iran realize that what's kept them down, the people who carried out that horrible massacre in January, maybe aren't as loyal as they were at that time, because quite simply they're not being paid. So I agree. This is going to be very fluid. We're going to have something different on the other side, and hopefully, with the strength of the United States, if that weakened entity is not able to assemble the same kind of power the old government of Iran was, we'll be able to establish that control you're talking about over the strait and ensure the free passage of shipping.
Victoria, just a final question, just briefly, if you can. You've worked with the president on high-profile foreign policy issues. There is a comfort in this market right now that the president is committed to de-escalation. In your mind, what would it take to return to hostilities?
It would take a provocative action by the Iranians. I mean, President Trump has wanted that as the last resort from the beginning. He has offered diplomacy repeatedly to resolve this issue. But if the Iranians make a horrible decision, and they don't have a great track record in that, they generally do make horrible decisions, then I think you'll see the reapplication of American might.
Victoria, thank you. Always appreciate your time. No doubt we'll catch up again soon. Victoria Coates there of the Heritage Foundation. That's the situation that most people in this market ultimately think we will avoid and certainly want to avoid.
And that's the reason why every extension of some sort of ceasefire discussion has been rewarded in markets, even if there isn't a clear sign of when that can actually begin once again.
Equity futures pulling back from all-time highs here. We're down by 0.5%. Tesla in focus. We'll catch up with Ben Kallo of Baird, with Tesla set to triple full-year spending. Plus, your has got your morning movers. ServiceNow falling on slumping sales. That stock is down by 13%. From New York City, you're watching Bloomberg TV. All-time highs coming into Thursday, just pulling back from those levels this morning from 0.5% to 0.6% lower across the board here. Down by 0.5 on the S&P, on the Nasdaq. Down by 0.52 on the Russell. Down by 0.59 on the Nasdaq. An amazing run we've seen on the Nasdaq 100 and for tech stocks as well. For the Philadelphia Semi Index, Lisa mentioned that 16-day record-winning run. We're on track for the biggest monthly gain for semis in America since the year 2000. We're up in April, and April ain't over. We're up in April so far by more than 30%.
You need memory and you need chips in order to execute the AI hopes and dreams that have been powering the American economy and have been powering the American stock market. So now the question is, do you keep buying, or have things gotten to such a top and have gotten so extreme that you want to back off? And right now people seem to be saying, let's keep buying because ultimately this is what's going to power the future.
How insulated is that market from this? Brent, WTI, inching higher again. 4 consecutive days of gains for Brent crude, back to 103. High by 1.4%. Yes, we've extended the ceasefire, but yes, we have also extended the closure of the Strait of Hormuz.
The ironic aspect of this is that as oil prices go higher, the more that AI stocks become sort of a moat of safety, and people are going to those. It's Europe that really is going to feel the brunt of it, and that's what every economic projection says. The longer this goes on, there'll be disproportionate cannibalization from the European economy, and you are seeing that in the equity move. So it's not totally irrational that the market seems to be shaking it off when you say that the market is a group of U.S. and frankly even Asian tech stocks.
It's PMI day today, and the PMIs in Europe, not good. Not good at all. Let's finish on the bond market. 2s, 10s, 30s. 2s so far this week, up around 10 basis points. Data's been decent. ADP, retail sales, jobless claims coming up later. Crude starting to bleed higher again. That's taken a 2-year to about 381.47. Yields up again this morning by 1 to 2 basis points. The good news, though, we are nowhere near where we were only 2 months ago, 6 weeks ago, when we were testing 4% at the front end of the yield curve. And I think this market's got comfortable with the idea that the bar for rate hikes is still incredibly high.
Yeah, and Kevin Walsh spoke to that to some degree in the hearings, not necessarily giving any view on rate cuts in particular, but talking about a new Fed regime that could allow you to cut rates in the face of AI productivity booms that he expects to see coming down the pike. A real question here about the long end, and I think that increasingly we need to keep focusing on that. If you reassess inflation and use a different metric to understand what inflation is as a forward-leading indicator and cut rates in the heels of that, does that lead to an unmooring of the long end of the yield curve?
10s this morning, 431, 30s at about 492. As we count you down to the opening, about 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Tesla shares initially jumped after earnings yesterday, but we wake up to a negative Tesla, down nearly 3.4% after announcing that it is boosting spending to more than $25 billion this year, surpassing analyst estimates and roughly triple last year's level as it ramps up spending on AI and robotics. Moving on to Lululemon, those shares also in the red, down nearly 4% after it named a new CEO, tapping longtime Nike executive Heidi O'Neill to lead this turnaround. But as you can see, the market not fully convinced because she's walking into a tough setup. Competition is heating up. It's in a proxy fight, and the shares are down some 40% in the past year. And we end on ServiceNow, those shares plunging more than 13% in the pre-market after the company says large deals are being delayed over the conflict in the Middle East. And in a market already nervous around software in the AI era, that is enough to send shares sharply lower, adding to a 30% drawdown just this year. John?
Yahira, thank you. Thank you very much. More from Yahira in the next hour. On our radar this morning, the standoff in the Strait of Hormuz intensifying. The White House saying it's awaiting a response from Iran. Tehran saying it won't restart negotiations until Washington ends its blockade on Iranian ports. Elsewhere, IBM trading lower in the pre-market. The company posting stronger than expected first quarter results and maintaining its full year guidance. The report failing to shake investor fears about AI disruption. That name is down by almost 7%. And finally, the NEC director, Kevin Hassett, saying Fed Chair Jay Powell can stay on as head of the central bank until his successor is named.
I think that's the appropriate legal understanding. And, we're all hoping that, Kevin is confirmed as soon as possible and that Jay moves on to a, happy and productive life.
So after May 15th, Powell is standing in. Trump will be okay with that because he knows Walsh is hopefully
I've not discussed that with the president.
I'm not sure if Kevin Hassett meant that to be a joke or not, but hoping Jay moves on to a happy and productive life got my attention too. I'll park that. The other piece of this that I think is interesting, Bramo, is that's now Kevin Hassett, the NEC director, suggesting that Chair Powell can stay on if Kevin Walsh hasn't been confirmed yet. And we've had the Treasury Secretary, Scott Bessent, also open the door to keeping interest rates on hold as well, for the time being, given the Iranian war, without any additional pressure, at least, coming from him.
Yeah, to me, you put these two things together and you have the economists in the room kind of pushing back a little bit to a president who's saying, I'm going to put the Fed chair right next to my office and I want him to cut rates really aggressively because they know what would happen to the long end of the yield curve. I think more importantly than whether the Fed chair will stay or not, if Kevin Walsh isn't confirmed, is a question of how Kevin Walsh is going to operate once he comes in, how he is going to overhaul the Federal Reserve, how he is going to overhaul the understanding of inflation, given the fact that he wants to look at gauges of underlying inflation instead of the one-time shocks that seem to keep percolating into our market. I mean, these are some of the things that people are trying to wrap their heads around. In the face of all of this, markets completely dead.
Inflation is a choice.
Yeah.
And as we joked yesterday, yes, it is a choice. You just pick your favourite index right now, and Kevin Walsh is maybe going in that direction. Well,
exactly. He's saying it's a choice, and I choose this index, which shows that inflation is pretty much close to 2%.
I'm not sure that's what he meant initially when he said inflation was a choice.
Well, that's the reason why we all took that as hawkish. Then the rest of the market said, well, actually, he's just choosing the index, and the index is a lot lower. So I like that choice. Keep cutting.
The NEC director says you can stay on. The president says you're going to be fired if you don't move on. It's an interesting dynamic right now.
It kind of goes to the whole Chris Wright thing, which is gas prices are going to remain above $3 probably for the remainder of the year. And President Trump says, I don't agree with that. So it's a difficult sort of needle to thread, considering the fact that we have people who are mired in these markets. And we have a president who is messaging a very different type of thing.
That's the latest on the Federal Reserve. Elsewhere, Tesla, those shares trading lower in the pre-market. The EV maker raising its full-year capex to $25 billion as it ramps up its push into AI and robotics. The announcement overshadowing strong first-quarter results. The stock down by a little more than 3%. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning. What were the big takeaways for you yesterday afternoon?
I mean, for Tesla, $25 billion is a monster number. A monster number. You know, capex previously peaked at about $11 billion in 2024. But the warning, right, is that because of their commitment to enter this kind of multi-year investment cycle to fund the humanoid robot, to fund the robo-taxi, the balance of 2026 is going to see them be in negative free cash flow. And so the market's immediate reaction this morning is they don't like that. You know, it's been so interesting. Elon Musk framed this capex commitment, which is up from the prior guide just last quarter of $20 billion for the fiscal year, as just being in line with the environment, right? He said, well, everyone else was doing it, so you should expect us to do this. Of course, Tesla isn't doing capex at the level that the hyperscalers are. But the way you introed the segment, John, is absolutely right, because what's so funny is all of the people saying, don't even bother talking about the car company bit, are kind of eating their hat. There was a lot of evidence initially when the print hit that demand is returning. And actually, the CFO, who often gives a lot more granularity than Musk does, said high gas prices are driving demand short-term, returning to EVs, which is really interesting. A lot of news was packed into the call. You know, Elon dropped a lot of sort of quick-fire commentary on the plan to build chip manufacturing. That drove the shares of Intel. But really, this is now Tesla in spending mode to deliver on the things that it's tried to keep investors looking to the horizon on for some time.
Ed, thank you, buddy. Appreciate the update. Ed Ludlow there. Look out for Ed later on this morning, 11 a.m. Eastern Time on Bloomberg Technology. That stock is slightly lower. I thought Lisa asked a fantastic question a little bit earlier on in the programme. Is this a gut check for the Metas, the Microsofts, the Alphabets, the report next week?
You can make an argument that Tesla needs to spend big because their auto manufacturing side of the business is not going to reap the kind of multiples that it currently is trading at. And yet when they say they're going to spend all of this money to invest in those hopes and dreams, people say, we're not buying it, we're going to sell. So if you get the Microsoft, the Apples, the Amazons, et cetera, Apple maybe is another story, saying that they're going to engage in much bigger CapEx programs than people expected next week, do we see some of the sheen come off the AI trade once again?
Wednesday is a big day for tech earnings next week, the same day, by the way, that we get the Federal Reserve decision. Let's get the view from the analyst community. Ben Kallo of Baird trimming his price target to 522, keeping an outperform rating, writing in the long term. We view Tesla as a core holding in the very short term. We think the stock is likely linked to the SpaceX IPO and potential merger rumours. Ben joins us now for more. Ben, we'll get to the earnings later. I've got to pick up on that line. Sure. It's so important. Yeah. What is the relationship between the performance of this stock and what's about to happen with SpaceX?
Well, good morning. Thanks for having me on. I think a couple-fold. First, the reason we think that ultimately the two companies make sense together. There's obviously synergies between operations. There's synergies between costs. There's a control issue with Musk that would help his control of Tesla if they did merge. But on the call, I found something very interesting. He said that when it was talking about the Terafab, about how difficult it was to get approval and the lengthy process of having to go to each individual boards. I think that's him priming the market for the companies to come together. And then just going back to the previous conversation you guys were having about CapEx versus the other Mag 7 companies and how they really dwarf Tesla's CapEx, even though they raised it from 20 to 25 billion. It's double what they did, more than double what they did last year. It dwarfs in comparison, and I think the two companies combined together can help get that scale needed to run in this CapEx AI race that Elon is certainly part of right now.
Ben, does it seem to you like Elon Musk is sick of running a car company?
I think that the car company is a foundation, and an important part of it, the car company, the energy business, which is very strong right now because we do need electrons, we need storage, we need generation. But for Tesla, the car business and the energy business, they are going to provide that cash flow, even though they're going to burn cash this year and into the really the foreseeable future. It does provide cash for that CapEx and that next generation. The car business also is the foundation for the robo-taxi business. It's helped them gather nearly 10 billion miles of data out there so that they can scale. And, it's interesting to see them scaling with a safety rider out into other Texas cities and I think that they'll continue to scale faster than originally predicted this year. Although it's taken a long time, I think that we're at a turning point there.
Ben, do you think that ultimately getting into Tesla now is a cheap option to get into the SpaceX IPO later? Is that kind of how you're seeing this play out as we expect that to come to fruition later this year?
I think that for patient investors, it is a way to invest in ultimately what we think is going to be a combined company, even on a standalone basis. I think in the short term, you have a flow of funds, maybe people raising capital from selling Tesla to buy SpaceX. That's out there as well. And then we're kind of in a wait and hold period to see if they actually do come together or what the plan is until Elon says no or go forward. It's kind of in this kind of lull here. But I think that if you're a patient investor, now's the time to buy.
Ben, if you want to get aggressive, let's pick out one final name. It's another name that you cover. Ben, GE Vernova, a gain of 100% last year and up more than 70% this year, up big time already this month, given the gain to the last 24 hours. The bar's high. They keep skipping it. How promising is business over at that company?
It's very promising. I think it's a great bellwether and a great stock that is right smack dab in the middle of all of the electrification, the energy generation. We're short on electrons, and I agree with the CEO of GE Vernova that we're in this super cycle, and we at least have a decade. Elon's talking about sending data centers into space because of energy constraints, and GEV's out there, providing gas turbines and then generation equipment, to hook up to the grid. And so they're right down the middle of it, and they have a long runway. They're getting price in their turbines. And I think that we'll continue to see that, our grid is going to be stressed and we need to invest heavily into it. We're underinvested in it. And now we're adding not only, new manufacturing, but, big data centers that are equal to the size of energy draws of major cities out there. And so a great way to invest in that long-term trend that we haven't seen before.
What a rally. What a rally. Ben, thank you. Ben Kallo there of Baird. We caught up with Scott back in January. He sounded confident then. I think there was good reason to sound confident based on these results.
When you take a look at first quarter electrification revenue, it is up 61% year over year from GE Vernova. When you take a look at power revenue, up 12%. A real question here about just how they can keep up with demand, and that really has been the story for all of the energy providers and the manufacturers of the equipment needed for it.
Quite phenomenal, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Back with us, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The Trump administration nearing a $500 million bailout of Spirit Airlines. Sources telling us here at Bloomberg the deal would give the government the option to take ownership of up to 90% of the carrier once it emerges from bankruptcy. United Airlines CEO Scott Kirby discussing the plan with Lisa.
This was a fundamentally flawed business model that I've been under, going back into the last administration, saying it's going to fail because the business model doesn't work. And so I think the spike in fuel prices just moves it forward by a couple of months.
Kirby sidestepped questions about a potential merger with American, but acknowledged that the current climate might offer opportunities for deals. Lululemon has named former Nike executive Heidi O'Neill as its new chief executive starting in September. O'Neill takes over as the athletic apparel retailer is facing slowing growth and investor unrest following recent product mishaps, including the sale of see-through leggings. Italy could make an appearance in the upcoming World Cup. The Financial Times reporting a top envoy to President Donald Trump asking FIFA to replace Iran with Italy, arguing Italy's 4 World Cup titles justify awarding it the slot. That is your Bloomberg Brief. John.
Vonnie, thank you. Obviously, I disagree. You've got to earn it on the field, the pitch.
I know.
No?
I know. Yeah, no. I think
not convinced?
No, not at all.
No?
I think that you still would go.
Obviously.
So, it would be a better marketing pitch.
Come on. I'm not going to pretend I'd be disappointed.
I know.
But I do think you've got to earn it.
Yeah.
And,
you have to earn it in order to pay for the tickets, frankly, to get there. So that's the truth.
You've got to earn it. Up next, crude under pressure.
This next Brent expiration, if we don't start seeing that convergence, then we may be in a position where no matter what type of news flow happens, the situation keeps getting worse and futures may not respond.
Oil back at triple digits. Brent crude on a 4-day winning streak. Paul Sankey of Sankey Research joins us next. Equity futures slightly negative, down by 0.5%. Our next guest is so keen, he already wants to answer questions we haven't asked yet. We'll get to them in just a moment. Calm down, Paul. On the Nasdaq, we're down by 0.5. At the surveillance this morning, let's talk about energy. Crude supply under pressure.
This next Brent expiration, if we don't start seeing that convergence, then we may be in a position where no matter what type of news flow happens, physically on the ground, on the water, the situation keeps getting worse and futures may not respond. The differential between them was never contemplated to be this wide. So in some sense, it's broken, right? And it may need to be reconfigured after this.
So here's the latest this morning. Crude climbing for a 4th consecutive day, back over $100 a barrel with the US and Iran seemingly deadlocked. Joining us around the table, Paul Sankey of Sankey Research. Paul, good to see you.
Hi.
Have you met Lisa before?
Yeah.
All right. Okay. Moving on.
That's an inside joke.
Inside joke. Let's go on.
We'll move on. Paul, before this war started, the day before, Exxon closed at around 150. Exxon closed yesterday around 150. Why hasn't this war and this supply hammering that we've seen in the last 2 months energized a rally in energy names?
Well, the energy names were running hard into this. They were the best performing sector of year to date, and that had, very much reversed. So you had tech going down, oil going up, and I think that was important because in many ways the market was adding terminal value into the oil. So what they were doing is they were buying on the basis that the oil age isn't ending. And, you had fundamentally more long-term value in Exxon. Exxon themselves had come out with their long-term energy plan in October, around the time BP capitulated, the IEA capitulated on the end of the oil age. So Exxon came out and said, actually, we think global oil demand is going to be flat through 2050. So the market began to think, actually and of course the AI energy requirement, natural gas requirement, the market began to buy in a very big way to the idea that the oils were fundamentally worth more because they have a much longer outlook for their products. And so that was bullish. But of course, when you get into this situation, and this is what we're looking at directly today, and I'll mention in passing that there's also been some profit warnings for Q1 that we saw, which is to do with inventory values changing massively because of the crisis. So you're going to have some very big headline losses reported by the oils in terms of their working capital in the earnings season that's coming up right now. But then what we saw here is that people are typically unwilling to buy into the oils at a peak price. And what we've seen at times is the oil price will come down and the oils go up. And that's big investors wanting to get into oil but not wanting to buy when jet fuel's $200 a barrel. But you can see the underlying bid is there. Now, of course, it gets more complicated because then we had this huge tech rally. So people were shoving money back into NVIDIA or whatever they were. So we didn't get part of that bid either. And I'll leave it to you geniuses to work out why tech was so strong. But I think that the AI theme has remained on course, and particularly the AI CapEx. And so there is an argument that the AI theme is, I mean, all the language from the companies is it is going to be vast, it is going to be huge, and people wanted to buy back in. But I think over the coming months, this is going to unfortunately deteriorate badly, this situation. It already is, but it's nothing to say that it's going to not be anything other than deteriorating over the next 2 months. We're locked into that. And so I think the market has, it's been a great rally, an all-time rally by some measures. But I think this is it's gonna come back to us. And I think, John, another one of your expert areas is the T. What we're looking at is the T-bill and how government finances can really handle this total disaster, and it's going to be difficult.
Before we get there, though, it's easy for people to say oil prices are going to remain structurally higher for the foreseeable future as a result of this, regardless of whether it gets resolved or not. Why is that not enough to give a boost to some of these oil majors, and why aren't we seeing them invest in CapEx?
Yeah, I think that's a good point, and I think it becomes a demand destruction case. So what happened, we have an almost opposite of COVID effect here, but what you saw with COVID is in 2019, world oil demand hit a record high. You structurally lowered it, and you had just fought your way back over 6 years, 5 years, to be at record highs again. Literally in February 26, you were at all-time record highs for global oil demand. And I think what you'll see out of this crisis is actually a structural reduction in oil demand, as well as a structural increase in the oil price. So I think that's one of the reasons why at this energy forum we were talking about this week, Kees van 't Hoff, the really outstanding CEO of Diamondback, was talking about the fact that the future strip's at $72 for next year. And there's nothing he can do with that. He can't sell into it, he can't drill more on it. It's really another interesting aspect of this crisis, which is the future strip is disincentivizing investment in more oil supply in the way that we need it. And so the companies aren't changing their CapEx plans. The AI guys are, Tesla is, but you won't see any, in my view, you won't see any public oil company make a major change to their CapEx plan on this Q1 earnings.
Paul, we've got about a minute left. You seem to think this is going to get very bad. And I just want you to spell out why, because there is a degree of comfort that people have got that we're on a de-escalatory path. Well, the comfort comes from the fact that the tankers only stopped arriving last week. It's a 40-day process. And so almost immediately what we've seen is the inventory numbers have now started to get scary, and it's just starting. But you're not at the stage of just outright crisis pricing. You're not at the stage where American very low share of their income goes to gasoline, 3, 4, it's 8, 9 in Germany. It's not that big a price. It's a sticker shock, but it's not really that huge an effect for the average American. Obviously, it's regressive and bad for poor people. So I think that the situation here gets worse simply because it's guaranteed. Normally when we're forecasting oil, we can be very, very wrong for extraneous reasons. In this case, we can be sure that the next 2 months is going to be an ongoing absolute disaster, even if you open the straits tomorrow, because it's just locked in by virtue of tankers. And the tankers are all in the wrong places. It probably means it's 3 months. So it's a very bad situation, and we're looking at where the supply chains are breaking. We've focused on Australia, on jet fuel. People are talking about solvents in Japan for chip making today. You'll see where the cracks really start to appear. And then finally, there's another issue, which is emergency inventories. The first slug is easy to release. The second slug, you're going to release it, but you're going to be scared. And then there's a question of, can you really release the third slug? So the emergency inventories are probably lower in real, actual terms than they appear on your screen, and they appear very low. This is quite sobering stuff. Paul Sankey, appreciate your time. Thank you, sir. Paul Sankey there of Sankey Research. Up next, Nate Thooft of Manulife, General Robert Walsh of Economy Securities, Daan Struyven of Goldman Sachs, Kristina Campmany of Invesco.
We're definitely seeing strength of the U.S. consumer accelerate.
That growth is coming across the board in the consumer segment.
Consumers are wary, but again, as long as they're working, I think they can make it through.
We do think you'll see inflation begin to recede.
It's very clear there's a lot of resilience in the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Snapping a two-day losing streak on the S&P in yesterday's session. All-time highs coming into Thursday, pulling back this morning by 0.4% on the S&P, on the Nasdaq by 0.3. In the commodity market, 4 days of gains for crude on Brent, back in triple digits, 103, and up by 1% this morning. And that screen is doing some real damage to the airline industry. We've seen the likes of United cut their outlook. We've seen Lufthansa slash flights, 20,000 of them going into the summer, and numbers from American Airlines just dropping.
Yeah, they said that they essentially met operating revenue for the first quarter. It met the average analyst estimate. When you look through here, you see that available seat miles are a bit above where it had been expected. They do have an adjusted loss per share of 40 cents versus a loss per share of 59 cents year over year. So a better than expected, lower than expected loss. That said, talking about the year ahead, talking about how expensive gas fuel is going to cost, jet fuel is going to cost, talking about how they essentially are going to hold a lot of their guidance flat. This is what we're going to be looking through as some of these earnings come through.
We're going to have some price pressures stateside. They're going to have shortages in Europe. That's different. And the way these airlines respond domestically in America and how they respond internationally in places like Europe could well be different too.
Well, in Europe, they're going to have to cut a lot of the regional flights, and we've already seen that from Lufthansa. For the United States carriers, a question of how do they prioritize international flights, given the fact that it's going to be really expensive to refuel on the other side to come back. How high are the prices, and how much do you see demand destruction as a result? You see American, you see United, you see Delta all prioritizing their premium offerings, and this really is key because this is where they make their money. And how much can they jack up those prices? $15,000 flights over to London and still get the business customer coming through, given the fact that ultimately it may cost that in order to get to the other side of the pond.
It's quite a headline, isn't it? American Air, more than $4 billion expense related to fuel costs. It's quite a number.
I mean, this is what you're seeing from a whole host of different airlines as people look through and see how much their expenses are going to go up. A question of how much can you keep passing that along to customers? Again, that is why they're leaning into premium, and that is where the bulk of all of the profits are coming from.
And that kind of speaks to the numbers we just got from American Express. Amex first quarter EPS 428, the estimate 403. The financials, the likes of American Express. Some of these names just speak to an economy that's doing better than okay.
Well, that's the reason why everyone has been reporting better than expected earnings. That's the reason why, even though American Airlines is reporting a loss and a $4 billion expense tied to jet fuel costs, you're seeing still the shares up in pre-market trading. American Express talking about premium card spending staying strong. So here's what we're going to have to ask economists. How much is this just the upper quartile being able to spend, the wealthier individuals and the K-shaped economy really expressing itself, and how much does this really express underlying strength that has been masked by what's going on, overshadowed by what's going on in the Middle East?
Equity futures are raising losses this morning, negative by 0.4%. Coming up this hour, we'll catch up with Nate Thooft of Manulife Investment Management after stocks hit fresh all-time highs. General Robert Walsh of Academy Securities on the high-stakes pause in the US-Iran talks. And Daan Struyven of Goldman Sachs as crude climbs back above $100 a barrel. We begin this hour with stocks pulling back following a record-setting session. Nate Thooft of Manulife Investment Management writing, the next few weeks will tell us whether strength broadens or whether this remains a narrow, high-quality earnings cycle. Nate joins us now for more. Nate, welcome back. Last time we caught up, you played down the risk of a repeat of 2022. Can you give us an update on your thinking now we've played through this story through the last 6 to 8 weeks?
It's great to be back. I agree that we are still in a world where I don't think 2022 repeats itself. We have a much more resilient economy. We have companies that have been through supply chain shocks before, so they're more prepared. And we have just general resilience that we're seeing across corporate America. And given how the U.S. indexes are skewed towards technology and financials, it's a world of have and have-nots within corporate world, just like it is a world of have and have-nots in the economy. And so we still have a very resilient underlying corporate America, which is driving risk assets, especially U.S. equities, higher.
The earnings from semis and the whole AI ecosystem have been phenomenal, incredibly encouraging. Overnight, we heard from Texas Instruments, strong forecast from them. We talked about GE Vernova yesterday, again this morning, making some big moves in their order book. In fact, the quarter in some measures was better than the whole of last year. Nate, the haves, they're the haves. Who are the have-nots in this equity market?
Well, there's a lot of have-nots, but if you think about the haves first, haves make up basically 80% of earnings growth this year. It's about 60% from technology companies, and another 20% is coming from financials. So the rest of the index, all the other sectors, are well under when it comes to potential earnings growth. And that includes everything from consumer names to the more cyclical names. The one area I would say that's still a little bit of a bright spot is part of the industrial sector and aspects of the healthcare sector. But everything else is not growing nearly as well as what we're seeing in tech and financials.
Does that mean it's an opportunity, or is that a warning sign, Nate?
I think it's a mixed bag. There are certainly some opportunities in certain sectors. We like a number of the industrials because some of the secular tailwinds behind that, whether it's AI build out, whether it's robotics, whether it's capital spending for the energy cycle, when it comes to just more efficiency gains, infrastructure for power, et cetera. There's a lot to like about industrials because there's secular themes that are playing into it, including AI. And then healthcare is the only sector in our view that can compete with technology from a secular growth perspective. It's unfortunate, though, there's just a lot of regulatory overhang and a lot of negative sentiment that has impacted healthcare in a more negative way. And valuations are showing that because it's historically cheap versus its average.
There's a real tension right now in markets, Nate, and I'm watching some of these earnings come through, whether it's American or whether it's American Express. This idea that the U.S. consumer can keep spending and they're willing to absorb higher prices to keep doing the things that they have enjoyed doing, which points to the inflationary backdrop that we might be looking at. People have been saying that this is going to be a one-time shock or it's not going to be long-term structurally inflationary. At the same time that the strength in the U.S. economy is raising real questions about that. How do you see that playing out through your portfolio?
I think it's an important dynamic. The reality is we have an environment where the wealth effect, particularly those on the higher end of the income spectrum, are doing very, very well. And as long as equities continue to do well, and that wealth is not impacted materially, you have a broad underlying driver, particularly for the upper echelon, to continue to spend and spend a lot. And unfortunately, on the flip side, you have a big part of the economy that's not benefiting from that, and they are struggling. And despite the fact that inflation probably is a bit transitory, as this is a one-time kind of shock, it doesn't mean it's going to go back down. So these prices are here to stay. It's just that the fact that the prices going forward may not go up as much as they have been going up. And so the reality is we still have versus have not economy when it comes to the health of the consumer. But do not underestimate the wealth impact as it pertains to the broader dynamics that drive consumer indices when it comes to the strength that it's showing.
Nate, back in 22, we had a very, very different central bank posture. At the Federal Reserve, there is a high bar to hike interest rates. What were your reflections on the hearing we had with Kevin Walsh, and how close are we to the next move from that institution?
I think it's hard to read too much into just the hearing because the reality is this is a person trying to get a job. He's going to tell them as much as they want to hear that's supportive of what he thinks is the right answer for what the outcome is for the Fed. The reality is they are going to still be a very data-dependent Fed, and this new member is just one voting member, not the only voting member. Right? And so we got to think about the weight of the evidence. We think the Fed is very inclined to cut rates if job data weakens, if growth weakens. But at the same time, they're perfectly content sitting on the sideline and holding pat as long as there's this lingering concern about inflation in the background and the job data still looks okay and growth still looks pretty good. And so we're in a wait and see mode for the Fed. But ultimately, we do think the Fed will still get in at least one, if not two cuts by the end of this year.
Is inflation a choice? And I don't mean with respect to monetary policy. I mean with respect to which index you look at to determine exactly what the inflation rate should be?
It is, clearly, because you have top-line inflation, and that's being impacted heavily right now by energy dynamics. And then you have broader inflation trends. And if you look at broader inflation trends, there's a lot of downward pressure, particularly when it comes to housing side of things, and when it comes to some of the areas of consumers that just aren't doing as well, and the spending on those types of dynamics, particularly household goods and furniture and things like that. So there's a lot of downward pressure on inflation, just as there's the upward pressure in other areas like the energy sector. So it is a balancing act, and the construct of those indices do matter when it comes to what that data looks like. But ultimately, we think what wins out is we do have inflationary trends, ex energy, that are still quite favorable to the downside.
It's nice to get a constructive view. We appreciate your time. Thank you, sir. Nate Thooft there at Manulife Investment Management with a constructive view, given the dire forecast that we had from Paul Sankey of Sankey Research about 15 minutes ago.
Yeah, especially because he said that there would be structural demand destruction as a result of higher energy costs, meaning that people wouldn't do certain things as a result. Well, maybe they wouldn't do certain things in Europe, but in the U.S., evidently, they're doing things just fine. I just wonder how this filters into inflation, because if people in the U.S. are accepting higher prices and able to keep spending, especially if they're at the upper echelons of the earnings spectrum, how does that filter out into pricing that affects disproportionately people at the bottom end of the K? I mean, this is the conundrum that the Fed might not have the tools to address, but will be faced with when they're making very political decisions.
That's the pushback to the 22 repeat. The labour market isn't as tight. The consumer price tolerance isn't as high. And for that reason, you're not going to get this broad-based inflation story. My question would be, without this war, how strong would this economy be right now? The Amex numbers we just saw moments ago, top in forecasts. We've seen this repeatedly across the financials and the banks. You've voiced this as well. I think very well played to you over the last 2 months to keep asking this question. From Mike Dada over at Roth, what if instead we've been having an underlying boom condition that has been partially suppressed by geopolitical turmoil and an energy shock?
That is essentially what all of these earnings are telling us, that we were seeing a boom condition that has been suppressed. Question now, how much can that boom condition continue and persist in the back end of this if this continues for a longer period of time? And that speaks to what Paul Sankey is talking about.
Equities recovering just a little bit. We're down by 0.4% on the S&P with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Pentagon telling Congress it could take 6 months to completely clear the Strait of Hormuz by mines placed by Iran. The Washington Post reporting that a senior Defense Department official laid out the timeline during a classified briefing. SoftBank is seeking a $10 billion margin loan backed by its shares in OpenAI. Sources telling us here at Bloomberg the 2-year loan will carry an option for SoftBank to extend the borrowing by an additional year. The company is taking on more debt for its push into AI. White House National Economic Council Director Kevin Hassett showing support for Fed Chair Jay Powell. Hassett saying Powell should remain at the helm of the central bank on a temporary basis if a successor is not confirmed when Powell's term expires next month. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Always good to catch up with Vonnie Quinn. More from Vonnie later this hour. Up next on the programme, locked in a leverage standoff.
The president has not set a firm deadline to receive an Iranian proposal. The president chose to extend the ceasefire because it's Iran who needs to get their act together.
Up next, we'll catch up with General Robert Walsh of Academy Securities, live from New York City this morning. Good morning. Stocks slightly softer, down by 0.4% on the S&P 500. Small pullback from all-time highs on the Nasdaq 100, down by 0.4%. We've talked a lot about this run in semis, but what a run it is. 16 days of gains, a record long daily winnage streak for the Philadelphia Semiconductor Index. And within that, some of the names putting up the numbers. Texas Instrument being one of them.
Yeah, Texas Instruments came out and boosted their earnings tremendously and their outlook as a result of AI-tied tools. You saw a similar kind of move from GE Vernova, also completely rewarded. Now the question is, can you see that kind of boom from some of the hyperscalers? Because this is the picks and shovels side of the story. This is sort of the energy, the memory, chips, et cetera, that has been absolutely surging. Can you see the actual users of it monetize it, or are they just fueling this gain because they're willing to pay whatever it takes to face off this existential risk?
And is it strong enough to insulate this market from this? Crude up by 1% this morning. Brent around 103, 4-day winning streak, and that's coming with a big bill for the airlines. American Airlines seeing over $4 billion boost in expenses due to fuel prices.
Yeah, and cutting their full year forecast for profits as a result of this. This is what we're hearing from all the major airlines. What they're leaning into, the premium offerings. They're talking about retrofitting old planes. They're talking about adding some of those business class in extra legroom types of seats, because that is where the profits are being made. Guess why? Because it is the upper income consumer that is fueling this consumer boom that we're seeing in the United States, whether it's American Express, whether it's American Airlines, or whether it's United.
Funded by Amex, I was going to say, topping estimates. At the same time, American Airlines were posting those numbers. Brent crude this morning at 103. Under surveillance this morning, locked in a leverage standoff.
The president has not set a firm deadline to receive an Iranian proposal. The president chose to extend the ceasefire because it's Iran who needs to get their acts together. The United States and President Trump have been very clear in our demands and our red lines and what we need to see in the best interest of the American people and our country and our allies from the very beginning.
So here's the latest this morning. Crude extending gains as the power struggle in the Strait of Hormuz builds and the US-Iran peace talks remain at a standstill. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John. Good morning. Well, the standoffs and the potential talks and over the Strait of Hormuz appear to only be worsening because at this point, the two are linked. Iranian negotiators have repeatedly said they won't resume talks until the U.S. lifts its naval blockade. The thing is, President Trump has maintained that it's not going anywhere. And new this morning, the U.S. military confirming it had intercepted 2 Iranian oil supertankers it says was trying to evade the blockade. Now, it is just the latest in what has been a series of efforts this week by Iran to try to test the U.S.'s limits, including the IRGC confirming yesterday that it had seized 2 vessels. Now, the White House press secretary actually went on there to say that the U.S. didn't view this as a violation of the ceasefire since the vessels weren't American nor Israeli flagged, but it does just underscore how dangerous conditions remain for nearly all shippers, as the Washington Post reports on this military assessment that was shared with Congress that estimates that Iran had laid 20 or more mines in the Strait of Hormuz and that it could take nearly 6 months to clear them. Now, we should say that a spokesperson for the Pentagon did tell the Post that that information was inaccurate, but it's adding to fears, of course, about how long it will take to get a safe strait. But, John, at least we can point to one effort at de-escalation, which is the White House coming out yesterday saying that the timeline for the ceasefire extension does remain indefinite in a bid to give Iran some more time to come to the negotiating table with a new proposal. We can confirm that Pakistan is still trying to mediate these efforts. Just yesterday, the country's prime minister did say that it met with Iran's ambassador.
No sign of a breakthrough just yet. Tyler, thank you. Tyler Kendall with the latest down in Washington, D.C. To extend the conversation, General Robert Walsh of Academy Securities writing this isn't a breakdown, it's a high-stakes pause, with escalation risk if neither side blinks. General Walsh joins us now for more. General Walsh, welcome to the programme. My first question for you, sir, is whether you believe the US has the leverage to force the concessions from the Iranians.
Hi, good morning, Jonathan. Great to be with you again today. I think right now, certainly, there's no question about what's gone on in the first phase of the campaign that's gone on with all the attacks and how far down Iran's military has been taken. There's no question at all the U.S. has the leverage. Obviously, there was a period in there where it seemed like Iran had taken some of that leverage back when they closed the Straits of Hormuz. But I think the counterstep, the chess move that the U.S. made to blockade the Straits and put both economic and military pressure on the Iranian government, this to me was really clear to show that they've got the leverage. And that's why I think right now the Trump administration is willing to sit back, give the Iranians more time because of the leverage that they have right now.
General, the Iranians have lived under very powerful sanctions for a long, long time. In the West, we have first world problems. We worry about a flight being cancelled for our summer vacation. Maybe we have to cut back on certain things. They've been living a very different lifestyle for an extended period of time. And I just wonder whether we're underestimating the pressure point for the Iranians. How do you reflect on that idea?
No, I think that's an excellent point, Jonathan. They can take a lot more. So right now, by putting an economic blockade, and we look at that, how long will that stranglehold take to really have an effect on a very radical Islamic government like that we're dealing with there? You could go back to World War II. You could go back to the Japanese. You could go back with how we dealt with Nazi Germany. It took a lot. You took a lot in the Civil War with Operation Anaconda to do a stranglehold. They can take a while. So that's why I think this is a move to show leverage to get the Iranians to the negotiating table. And I think there's going to have to be some small concessions on the U.S. to get to some type of off-ramp to get to those negotiations. Because if it's just straight the blockade and the pressure, we don't know exactly how the Iranian government will act. But they certainly could sit down and hold back for a long, long time.
General, in the meantime, on the U.S. side, there have been a number of high-level departures from the U.S. military ranks, the latest being the Secretary of the Navy, previously the Army Chief of Staff. How do you view these departures in light of the larger scheme of things? Does it seem more like signal or like noise?
I think when it comes to the troops out in the field, the sailors, the Marines, the airmen that are out there conducting these operations, this is really noise to them. They've got a very focused operational commander in Admiral Brad Cooper. They're focused on the mission, and having been in these type of missions before, you're just heads down, focusing on what your mission is. That's all noise back in Washington. They focus on what their commanders are doing in theater, and they get at the mission. So that's a lot of things that go on in Washington that will not really affect the mission at all.
At the same time, a number of people have come on the show and said from a military execution standpoint, it's been excellent. And as far as accomplishing the goals set out, there's a real question strategically of how to accomplish the end result that people are talking about, which is a Strait of Hormuz that can allow free travel of shipments without paying a toll to Iran. What is the way to get there, given the fact that it seems unlikely that this regime in Iran would give up one of the only levers that it has of leverage?
Yeah, I think the key thing here is it's going to take both diplomatic, economic, and military pressure on Iran. It's all of those things. It's the hammer in the background that the military can bring. And all Iran has to do is see the vast amount of military force that the U.S. has continued to bring to make it even larger when, Operation Epic Fury started. We've got more forces there. So that hammer is there. And you see how far the Iranian military has been reduced so far. But now it's going to get to negotiations, because comparing back to your last point is this regime is willing to sit down and take pain for a long time. So I think it's going to take both the economic pressure on there. It's going to take the diplomatic side. It's going to need to get to the negotiating table with the Iranians. And right now, the problem with getting to the negotiating tables is because of the split between the politicians and the IRGC, it's hard to get to a unified position. So the Trump administration, I think, did the right thing by giving the Iranians some time to pause, an indefinite ceasefire, to really kind of get their act together, to get a unified position, to come forward with a term sheet on what they're looking at to get the negotiations started. Those negotiations, once they get started, now they can have the discussions about starting to open the Strait of Hormuz and releasing that pressure that's on the world markets today.
General, how comfortable are U.S. partners in the region with an open-ended ceasefire?
I think at this point, Jonathan, that they want to see the war end. The ceasefire has occurred, but they want to see this end in a good way. So I think their positions align very much with President Trump's. They don't want to walk away from this and we go on for this for years and years and years. They want to end this. So they're hoping that between the military and economic pressure that is on them, we can come up with a good solution. So I think they're very much aligned. In fact, I would say, and they're aligned so much that they want to see this through in the same way the Trump administration sees it, that we end this and we see Iran as a viable neighbor in the Middle East, and bring them into that. As difficult as that may be seen with this radical government, that's the end state we'd like to get to, where we don't see this constant cycle of violence that's gone on in the Middle East, all caused by Iran over many decades.
That would certainly be a major win for the region and for the world for that matter. General, always learn something when I catch up with you. Thank you, sir. General Robert Walsh there of Academy Securities on the pressure point for the Iranians. And just the idea that this could go on longer than you think.
You asked the key question, though, which is, will the regional partners be okay with that? The goal might be right, but how do you get there? And that ultimately is really the detail that's the sticking point.
Coming up on the programme, we'll catch up with Daan Struyven of Goldman Sachs, with crude back at triple digits, plus your hires back with your morning movers. American Airlines rising on strong first quarter demand, but held back by a major expense associated with fuel costs. That conversation up next. Equity futures pulling back from all-time highs. We're negative 0.5% on the S&P 500. Similar move on the Nasdaq, down 0.4 on the Russell. The small caps down by 0.6. The guide coming from corporate America pretty decent. Strong forecast from Texas Instruments. Strong numbers from American Express. First quarter EPS 4.28. The estimate just north of $4 a share. We'll get to some of those names in just a moment. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We've gotten a wave of earnings this morning, and we start with American Airlines flipping to negative, down 0.4%, even after stronger than expected results with losses narrowing and demand holding up. But the bigger story and what's weighing on this name is what comes next when it comes to fuel. The airline warning that higher oil prices could tack on more than $4 billion in costs this year. Moving on to a name in the positive, American Express out now just slightly, but still in the green. The credit card company beating expectations as its premium cardholders keep spending. Transactions jumping 10%, showing some resilience at the top end of the consumer. No surprise because of what we hear on this program all the time about the K-shaped economy. And we end on Tesla. Shares are falling 3% in the pre-market after announcing it is boosting spending to $25 billion this year, surpassing analyst estimates of about $20 billion and about triple last year's level. John.
Yahira, thank you. More from Yahira later in the programme. On our radar this morning, crude rising as peace talks in the Middle East remain on pause. Iran saying it will not resume negotiations until the US naval blockade is lifted. President Donald Trump demanding Tehran hand over its stockpile of enriched uranium. Elsewhere, Lululemon naming former Nike executive Heidi O'Neill as its new CEO starting in September. O'Neill facing the immediate challenge of easing investor concerns and regaining market share in the very competitive athleisure category. And finally, American Airlines and Alaska Air are discussing a major revenue-sharing partnership. Sources telling us here at Bloomberg the deal would include adding Alaska into American's global network in an effort to better challenge rivals.
This comes after we get the American Airlines results for the first quarter, cutting full-year earnings forecast as a result of higher fuel prices. How much do we see an acceleration of mergers and acquisitions in the airline industry as a result of higher fuel prices? It also comes as American Airlines tries to rebut United in a very personal type of squabble between these two airlines, with United looking or reportedly vying to buy American Airlines. American Airlines saying we're absolutely fine, ruling out some sort of acquisition or merger with Alaskan Air, but still coming up with different ways to fortify their earnings stream.
I'm always tracking people's body language in an interview when I'm watching them and when I'm conducting them at the same time. And when I was watching you interview Scott Kirby and you asked him about this, there's this very interesting moment where he just looks off camera, smiling, almost looking at his team as you ask him that uncomfortable question about going after American Airlines.
He didn't answer the question. He can't answer the question. I'm sure his legal would have a coronary. The question, though, ultimately is, what would be the goal for United should they want to buy an airline? They talked about international presence because that's where the money is. They want an international type of footprint, and they consider their rivals, the international airlines that have a disproportionate number of flights of U.S. customers to Europe and back. So they want to get that share back. This is the pitch, I'm sure, that they're making to the antitrust regulators, saying, ultimately, we need a strong U.S. airline, and our competitors are international, not necessarily the big three. American is saying, look, we're fine. Look, we even have a revenue-sharing deal with Alaska Airlines. Either way, the pressure of high oil prices very much prompting an acceleration of some of the M&A that we otherwise might have seen down the line.
So what did you sense that he really wanted? Some gates, some access to, say, JFK, to do that through some kind of merger, some kind of acquisition? What do you think he wants?
You know, he didn't say. He said that ultimately he's more interested in international. He kept repeating that. So it seems like it's perhaps a little bit more than a couple of gates. There also is a feeling that the international scheme has really changed, especially in light of how high oil prices have gotten, and frankly, the fact that a greater proportion of the dollars are coming from the premium customer. So if you want to make revenues in a consistent way, you are going to have to really get a bigger part of that share going internationally. And how do you do that? Well, it isn't small. That, I think, is the key point.
It was a great exchange, a very cool exchange. Check it out on Bloomberg.com and the Bloomberg terminal. Lisa catching up with Scott Kirby of United. Let's talk about energy. Brent crude higher for a fourth consecutive day as the US and Iran angle for control of the Strait of Hormuz. Daan Struyven of Goldman Sachs writing global visible oil inventories are likely to reach record low levels, even in an optimistic scenario where flows start to recover by the end of April. Daan joins us now for more. Daan, good morning.
Good morning. Thanks for having me.
You can see how things are set up. You've got visibility of the tankers that have arrived and the ones that aren't coming anymore. Can you describe what the next 2 months is going to look like?
Yes, so global visible oil inventories, I would say, fortunately for the world, were at pretty high levels before the war started. But the pace of global inventory drawdowns is just so sharp, around 11 million barrels per day or so, that because of the bottlenecks and the logistic supply chain time it will take for the system to reset, that even if we start recovering flows by the end of April, we're on track to reach the lowest level for global visible oil inventories. Even if lows start to recover by the end of the month, and we honestly just have never seen how oil prices react at such low levels. So we have to recognize that implies some upside risks to our forecasts, which are based on historical data.
Does that aggressive drawdown in inventories explain why something like, say, dated Brent is some $40 off the highs?
Yes. So the dated Brent is still, $10, $15 higher than the June futures contract. The main reason is there's a big premium on getting oil sooner rather than later. The June Brent futures contract gives you the right to get oil in June. Dated Brent gives you the right to get a cargo in the next 10 to 30 days. And because some market participants assume a high probability that by June things will have normalized, you have this big immediacy premium on barrels now rather than later.
We were talking to Paul Sankey earlier and making the point that whatever happens, whenever this gets resolved, it seems like there's going to be a structurally higher level of oil prices going forward and commodity prices going forward. Why wouldn't the oil majors in the U.S. be investing significantly more to produce more? And he said because the longer this goes on, the more there is structural demand destruction for oil. Do you agree with that?
Yes. If the supply disruption is very sustained, I would downgrade or constructive long-term oil demand estimates. The best illustration, I think, is what happened in the 80s. After very high oil prices in the 70s, you saw a very sharp drop in oil demand per dollar of global GDP produced. Now, if the disruption is relatively short-lived, and I think that's still the market's central expectation, I would expect somewhat more limited effects, especially in the short term, because, for instance, households don't buy a car every year. In the short term, we don't have that many switching opportunities. Lower GDP tends to be the bigger adjustment mechanism from very high refined product prices.
What replaces it? I mean, is it just sort of lowered GDP on a prolonged period of time? Or are we going to see other sources of energy that start to pick up? I mean, is that sort of an investing theme that you're looking for right now?
Yes, we do think so. We think this is actually a period that is pretty supportive for the global energy capex outlook, both because within traditional oil and gas, we'll need to invest into diversification, because we've learned that the risks from reduced supply from the Middle East is high. And it's also an incentive to diversify into other energy sources. And we are already seeing switching into renewables, into coal, because you can produce coal at home in Asian countries. And I think we're also seeing a pickup in EV sales. So I think the shock really supports the need to invest in all of those above, in all the energy sources.
Have you been surprised, and this is probably not the question you expected, but surprised that crude's not higher? Yes. Have you been surprised by how low crude actually is? And I mentioned dated Brent. Dated Brent is at 111. At the start of April, that was approaching 150. That's come down. Maybe inventories explain that. You and I talked about that briefly. But the idea that Brent now is at 102. At 102, when back in 08 it was trading close to 150. And what's the 150 equivalent in today's money? Something north of 200?
So I think there are three factors. One, product prices are still very high. They've also moderated. But ultimately what matters for demand, for real income, inflation growth is product prices. Two, since the hostilities ended, I think the market, especially the equity market, has sharply downgraded its probability of a very lengthy disruption and of scarring to oil production potential. So that has taken out the tail of the price distribution. And then third, I think many market participants in the physical world, including, for instance, oil consumers, also think now that it's plausible, likely that the war will be over in a few months. And so they're actually destocking. If you expect that it's likely that you can buy at a lower price 6 weeks from now, after panic buying, massive restocking in March, you hold back and you hope that prices come down. Of course, that's not sustainable if the flows don't recover.
So there's not any funky business going on in the futures market, as far as you're concerned?
We don't think so. I think the cleanest evidence is sort of the price of a so-called exchanges futures for physical, EFP, which essentially allows you to convert a physical futures contract into a physical cargo. And that price never exceeded $2 per barrel. So the physical markets and the futures markets are not as disaligned as some people believe.
How much is this because the Chinese strategic reserve of oil dwarfs everything else added together. I was just looking at a tweet highlighted by Javier Blas, looking at how the Strategic Petroleum Reserve in China is equal to that in the United States, Japan, Europe, and Saudi Arabia all added together. I mean, how much is that buffering a lot of what we're seeing right now in oil prices?
Yes, it's a very big buffer. It's a key reason why we think China has time. We think that inventory levels in China would not reach critical levels until the summer. For now, based on the data we can track, we have not seen large declines yet, large releases in China SPR reserves. But because the market knows China could do this arguably dampens some of the upside to prices.
You keep saying that if it's a temporary shock. Initially, a temporary shock was a couple of weeks.
Yep.
Then it was a couple of months. Then it was, well, as long as it's resolved before June. Now it might take 6 months to get rid of the mines that are currently in the Strait of Hormuz, according to intelligence from the United States, as reported by the Washington Post. I mean, how do you put this together and get a sense of what temporary means, what prolonged means?
Yeah, the longer this lasts, and if this lasts more than a quarter, the main adjustment mechanism becomes lower demand and lower economic activity. For a 2 to 3 month period, you can draw down inventories at a very rapid pace, in part because the starting point for inventories was quite high. But this is not sustainable. And so, if this continues, demand losses are unfortunately the main adjustment mechanism.
I've said this a few times, really enjoyed your research throughout this war, so thank you for that.
Thanks
to you and
so
the team.
much.
Thank you, sir.
Yes.
Daan Struyven there of Goldman Sachs on the energy market. Let's give you an update on stories elsewhere with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. A high-profile shake-up at the Pentagon. Navy Secretary John Phelan fired after clashes with top leaders. According to a Pentagon spokesman, Undersecretary Hung Hao will replace Phelan, who is stepping down, effective immediately. In markets, a check on shares of American Airlines, down about 0.7% in the pre-market. American beating expectations for first quarter earnings, seeing robust demand in the first quarter. The company expecting the midpoint of its full year guidance to be approximately flat versus last year, despite more than a $4 billion cost extra tied to higher jet fuel prices. American Express in early trading up about 0.2% now. Amex topping estimates thanks to strong spending from its premium credit card. Build business jumped by 10% from a year earlier. The company maintaining its full year guidance, expecting revenue to rise 9 to 10%. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate it. Thank you very much. Up next on the program, maintaining dollar dominance.
Many of our Gulf allies have requested swap lines, and swap lines are to maintain order in the dollar funding markets and to prevent the sale of the U.S. assets in a disorderly way.
Up next, we'll catch up with Kristina Campmany of Invesco from New York City. This is Bloomberg Surveillance. Stocks recovering here. We're down by just 1/3% on the S&P. Likewise on the Nasdaq. Small pullback from all-time highs. So far, so good on the earnings front from American Express, from the likes of Texas Instruments. Next Wednesday, just to frame next Wednesday for you, you're going to have a Federal Reserve decision in the afternoon. And after the close, Meta, Microsoft, Alphabet, and maybe Amazon too. I haven't seen that confirmed just yet, but a big number of major tech firms reporting that afternoon.
Key point's going to be watch. What is their capital expenditure plan for the upcoming year, for 2027? Do they give any guidance for that? And do we get the same response that we got from Tesla? Tesla increased its capex to $25 billion from $20 billion, and the stock fell after beating expectations on the earnings from their car sales. So a question here for the big hyperscalers. Are they seeing a warning sign from what we just saw from Tesla?
Not expecting them to triple their capex, are we, next week?
You know, you never know. They've done it before. They can do it again.
It's the latest on Tesla, the latest on the equity market. Here's the latest on crude. Higher for a fourth consecutive day on Brent, 102.40, up by 0.5%. Under surveillance this morning, we'll talk about foreign exchange, maintaining dollar dominance.
Many of our Gulf allies have requested swap lines, and swap lines are to maintain order in the dollar funding markets and to prevent the sale of the U.S. assets in a disorderly way. So the swap line would both benefit the UAE and the U.S. And as I said, numerous other countries, including some of our Asian allies, have also requested them.
So here's the latest this morning. President Donald Trump confirming the U.S. is considering a currency swap with the UAE as nations hit hard by the war. Look for liquidity. Kristina Campmany of Invesco making the bear case for the dollar, writing, our structural thesis for a weaker dollar over the medium term to long term is only amplified by recent developments. Kristina joins us now for more. Kristina, good morning.
Good morning. Thanks for having me.
What is it about recent developments that will contribute to a weaker dollar?
Look, I think that this has been our structural base case for a while, and you started to see the beginning of this thesis play out in 2025, and there obviously dollar trends are long trends, but when we take a step back, I think in the last year and a half, we have continued to chip away at the institutional credibility of the U.S. and the Fed and kind of questioning of these things. You've had changes in kind of the norm of world order for the last number of years of economic interdependence, but also security. And I think all of those things kind of continue to build a backdrop for a weaker dollar.
The counterpoint, as you know, will be that this is a relative trade. It's got to be against something.
Sure.
And the something right now is not great either.
Yeah.
I saw German GDP forecast of just 0.5%. Do growth differentials matter when you start to think about these things?
So I think that they do. But again, you take a step back and you say broadly, the dollar still looks overvalued. I think if you look at 2025, euros moved a lot. EM currencies performed, but again, on a long structural basis, have underperformed. Asia is the clearest kind of region that didn't participate. And I think coming into the year, that was like the cleanest case. That is obviously challenged by the Iran conflict because these are all oil dependent or importing countries. So the mix still matters, but I think there are still opportunities in Asia. I think there has been a pullback of attention and money into EM and carry there for sure. And Europe, I mean, I would just take the step back that the data is not great. You obviously, how long this conflict goes on will matter for sure. And what you said about the U.S., we are energy independent. We're talking about, like, are we changing flights in the summer? Are we changing vacation plans versus are things actually being canceled? There is no oil to have things operate in Europe. That is 100% true. But I think we structurally have a bias in the market that people are much more negative on Europe than is warranted.
Well, at the same time, some people are saying if you're so negative on Europe, why don't you invest in long-term bonds there? Because ultimately, the ECB is going to have to cut rates based on the GDP preprints that some of these countries are putting out. Is that something that you would endorse?
So look, I think we talked about this a bit last time. I think across rate markets, the front end of markets is still what is most interesting. And I think part of the step back from that is in the last 2 months, the reaction to all of this and the inflation shock has just really been a repricing of the front end in a dramatic way. The ECB obviously has a different mandate than many of the other global central banks and seems most willing to react and to hike into it. We think that's a mistake and that ultimately the growth issues there don't really warrant hikes. But I think you need a steepening of the curve and a bit more premium. We're starting to see that a bit. So I think we will get to a point that out the curve, there's some value. I think in the UK, that's like the one market that there is some steepness in the curve and there's value out the curve.
At the same time, you just have to wonder at what point dollar weakness and the trends that underpin it will cause a reduction in demand for U.S. assets, in particular U.S. debt. And we're talking about potentially the Middle East, which just months ago was talking about investing billions of dollars in the U.S., getting a potential swap line from the United States to help with liquidity matters. I mean, isn't there a fear that there will be a pullback? Are there any signs of that actually happening?
So I think there's definitely a fear, and I think that these comments and the information that we got from Besson and Trump confirming that speaks to that of, look, we know that there's been a stop of business and the normal business of as usual, certainly in the Middle East, but more broadly. And all of these nations are tied to the dollar. Their currencies are tied to the dollar. So rather than, I think the effort is in a liquidity effort to make sure that kind of there's normal operations rather than having to go sell U.S. assets. But I think when we come back to the early 2025 themes of, do you have this broad dump of U.S. assets? I don't think it's that. But when you say investors globally are very overweight U.S. assets, so on the margin, is there still a willingness to put the next marginal dollar of investments into home country or home region or diversified more globally, I think that's absolutely still a theme that's with us.
Lots of selling and less buying are two different things.
Mm-hmm.
I think we're in the less buying part of the story, and that's kind of been where we're at since the start of the year, Bramo.
Yeah, what I find fascinating is that ultimately a swap line might be an effort to not have more selling. It might just be, okay, if you want to buy less, that's fine, but not have it be a massive move in the immediate near term. And that, I think, is a notable thing.
Are those conditions supportive enough for corporate credit?
I think corporate credit is like where we are kind of the least comfortable in the market. And
What's that?
It just spreads are still so tight. Like, we are at extremely tight valuations, and we obviously have a K-shaped economy in the U.S., and the wealthy are underpinning growth, and that kind of continues to be what we see with earnings so far. But that can only go so far, and we are 8 weeks in or 7 weeks into this conflict. The repercussions and growth impacts in the U.S. and globally are still playing through and will hit the consumer, right? Or will hit the corporation. And if you start to see layoffs, the labor market is in this very tentative place. So there's like a lot of things that are very finely balanced, and kind of any shocks to that you can see trickle down.
Is it energy within the high yield sector that is keeping those spreads tight? Is something else happening? Is there a sector you're worried about?
Again, I think the market, as a rates person, we always struggle with this concept that credit people talk about like all-in yields. Like, all-in yields when spreads are so tight, like, go buy T-bills. But like, that is certainly, I think, a concept that does reign in the market. And I think after so many years post-GFC of such low absolute kind of coupon yields that you were getting in credit, there's been a period that just the level of yield attracted people. I think that we're a little bit more cautious of just how does that play out.
Kristina, good to see you. Appreciate the caution. Thank you. Kristina Campmany of Invesco. We've had lots of constructive views on this programme, just to balance things out. A note of caution. I have to tell you, though, as we're having this conversation, a cautious one, the equity market is erasing losses this morning. We're down by not even 0.2% on the S&P.
It's the push-pull that we kicked off the show with. On one hand, you've got what's going on in the Middle East. On the other hand, you've got earnings in corporate America saying things are amazing and they might look a little bit worse, but they would have been absolutely blockbuster. And that is really the read-through getting to
That's the story, isn't it? You've said this a few times, would have been absolutely blockbuster. There's almost an underlying boom, and you saw that in the airlines. Before this war started, the demand numbers they were talking about, United and Delta, stellar.
Yeah, the One Big Beautiful Bill actually did deliver those refunds that allowed people to go out and spend. It is the upper-end consumer, though. American Express, premium. American Airlines, premium customer. United Airlines, premium customer. It keeps going back to that trend.
Up next, the premium guest, Eric Cantor of Moelis, Caso of Wolfe Research, Nela Richardson of ADP, Nisha Patel of Parametric. The third hour of Bloomberg Surveillance just around the corner.
Markets remain relatively buoyant and hopeful.
That bounce back that you have is warranted.
We're clearly pricing out a lot of the tail risk. The stock market has been the most accurate indicator of where the economy is going.
If you're looking 6 months out, I still think we're higher than where we are here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Coming into Thursday at all-time highs, a small pullback of just 0.16% on the S&P 500. On the NASDAQ, down by 0.17, supported by a major tech boom across several companies and the premium consumer in the United States of America.
That, to me, is the key point. It's not just AI. It's the fact that consumer spending among well-heeled Americans seems to be holding up, and then some. American Express, profit rising, premium customers piling in. They can spend, and what are they spending on? They're spending on flights. That's one of the things they're spending on, because you're seeing that also from American Airlines and United and Delta, all talking about the premium customer. The path forward is the question. How much does the war in Iran really crimp that versus just simply put a damper on what otherwise would have been a blockbuster year?
Equities are raising losses as crude erases gains. We're pulling back from session highs on Brent crude. Brent at 102, WTI at 93. And those numbers still bringing a major bill to the likes of American Airlines, a major fuel bill.
Yeah, $4 billion, which is part of the reason why they ratcheted back their full-year earnings forecast, which you've seen the same kind of move from United. Delta is simply unwilling to restate their earnings forecast because there just is no visibility. At what point does that really create a serious problem? And are we actually gaming out costs that are relevant to what the forecasts are from some of the geopolitical strategists? I mean, I'm trying to wrap my head around this. If it takes 6 months to detonate the mines that potentially were buried in the Strait of Hormuz, we're talking about maybe a ceasefire, but with whom and how? And we're talking about the fact that we're still not seeing commerce through the Strait of Hormuz. How does this get resolved in a way that ameliorate some of these price pressures in the near term? And I think that is one of the reasons why oil strategists come on and they say, we don't really get this move. And we keep saying, well, but stocks keep ripping. So, it is what it is.
Choices and trade-offs, and you're starting to see them being made, not just in Asia. That was up front, now in Europe. And keep going back to Lufthansa, cancelling 20,000 flights. There are some unprofitable trips that I'm sure they wanted to cancel up front, and they'll try and maintain some of the more profitable trips. I just wonder how close we are to the transatlantic players making similar decisions about how much emphasis they want to put on certain routes versus others.
Yeah, are we going to start to see maybe a flight to, say, Toronto versus a flight to New York, which they would want to go if you're going from London? Look, right now they want to preserve the transatlantic corridor because that is the most profitable. And right now they're willing to cut the shorter end of the flights in order to say, OK, just take a train.
We've got some data a little bit later. It's about 27 minutes away. Jobless claims in America. The data so far this week, so good. Looking at retail sales, stronger than expected. ADP numbers, better than expected. There is more than just resilience in this economy. This economy, based on the numbers we've seen so far, is more than just resilient.
There's been heat, and I keep going back to the idea that Scott Kirby of United was surprised by how much there was not demand destruction as a result of prices going up. It gives you a sense of just how much heat there is in this underlying economy.
Coming up this hour, we'll catch up with Eric Cantor of Moelis and Company. With stocks pulling back from all-time highs, Chris Caso of Wolfe Research on the record-breaking run for chips, and Nela Richardson of ADP breaking down the latest jobs data. We begin this hour with stocks lower and crude rising as peace talks in the Middle East remain idle. Eric Cantor of Moelis and Company writing energy independence and domestic production are key to insulating the U.S. from global shocks. Eric joins us now for more. Eric, good morning. It's good to see you.
Jonathan, it's great to be here.
In the present, it's tough. In the future, things are looking better, according to financial markets. What's going to shake this market out of such a powerful, forward-looking mindset?
Look, if you think about where we are, and I know the discussion around the table this morning has been the incredible resilience of the American economy. And I think that if you look at it, a lot of it has to do with some shock absorbers that, frankly, the Trump administration in Washington has been put into place. You've just experienced big tax refunds that came out of the One Big Beautiful Bill. You now have a shock absorber, if you will, that is going to be afforded to the corporate community in the terms of a $160 billion tariff refund. You've got actions on the part of this president that said, hey, we're going to go and ease this oil crunch by releasing more of the strategic petroleum reserves, the waivers on the Russian oil. And ultimately, you've got a very pro-business administration in Washington. So you've got a regulatory construct that is much more constructive than we've had in the past. So I think all that helps when you see these earnings, helps explain where we are.
Do you think we're underestimating the momentum going into this war?
I do think so, and I think that there's not been a lot of credit given to this construct, the policy construct we've operated in. Certainly, the liquidity that's out there with a high-end consumer has not abated yet. But I don't think we've necessarily gotten to peak shortage yet. And just as your guests have been discussing on the show this morning, I do think that we've got real uncertainty as to where and how you're going to see these oil flows resume so that you can get back to normal.
Blackstone just came out with earnings. They said this is going to be the year of the IPO. They still think it's going to be an unprecedented year for IPOs. We've heard that from a number of companies, that mergers and acquisitions going incredibly strong. When you talk to companies, given the uncertainty out there that you just reflected, how much are people willing to carry through with some of these plans, given that things could change a lot in the next couple of months?
I think, the market's clearly looking through the short-term uncertainty in the Gulf. I mean, there's no question about that, and it's undergirded by the earnings. But, if you look at the forces that have been at work, and I talked about some of the policy forces, but if you see in the commercial world and where companies are with this technological revolution that we're experiencing, with the AI boom, companies are thinking, how am I going to position myself? Boards and management are saying, hey, what do we have to do to take advantage of this? And you've got that tailwind that continues to push forward in terms of people saying, hey, maybe we should transact. Maybe we should accomplish more scale in order to take advantage of this situation. And then obviously in the world of private equity, you constantly have this need of recycling capital. You constantly have a need for return of liquidity to the LPs. That hasn't gone away either. So in many ways, the structural pillars that have supported the environment to transact have not gone away either.
So you don't think that what we're seeing right now in the Middle East is going to deter the pace and frankly, the pipeline that people were talking about, which was unprecedented heading into this year?
Well, look, there's no question that there are going to be specific areas. Individuals, entities in the Middle East are certainly not in the same state of mind as they were 8 weeks ago. So there are going to be geographies and there are going to be certain areas. With the AI situation and private credit and software, certainly that's going to have an impact right now. But that, I think, is a short-term sort of thought that longer term, you've got these structural tailwinds that are continuing to propel people's willingness to say, hey, we want to do something. Things are moving too rapidly.
So many people in this industry are incentivized to keep on dancing. We could see 3 of the biggest IPOs we've ever seen in the history of this country. OpenAI, Anthropic, SpaceX, all in the next 9 months.
And it potentially could change the dynamic that we've seen in terms of assets in the U.S., where people were talking about a scarcity of stocks and the buybacks that have been going on for so long. And suddenly we're going to see the biggest expansion of U.S. equities, public equities, that we've seen in many, many years. So there are a lot of structural questions that are facing this market later this year.
Eric, we've struggled with reality versus hype. I'd like your view on that. When I say everyone's incentivized to keep on dancing, it's a little bit of snark in that as well. I think everyone's incentivized to say things are maybe better than they are at the same time because everyone's got to make some money later this year, particularly off those 3 big IPOs potentially. What is real and what is hype right now?
What is real is we have sort of an era of revolution right now. You think about sort of the geopolitical revolution, the trade revolution that's come into play with this president. You think about the technological revolution that we are experiencing. All these forces are coming to bear that really is the reality. People are trying to understand how to best position themselves, their capital, their companies, to take on these new times. And I think that is reality. And there's incentive for sure to try and benefit from a lot of the changes.
You call them forces. Other people might call it friction. And with that increased friction comes increased costs. What's your reaction to that?
Well, I do think it's increased costs if you do it the old way. If you're going to go in and try and embrace the new way, that's where everyone's trying to get to. And that's exactly the point. That's the dynamic, whether you call it friction or whether you call it, a tailwind or a force, that is the mechanism that is saying to people, hey, we need to stand up, look at where the opportunities are. Otherwise, we're going to be left behind.
Which is why there is such an aggressive forward-looking mindset in this market right now. We spoke to Jim Zelter of Apollo in the last month, several weeks ago. He sat in your chair and he said, we all need to take a walk because in 6 months' time, we won't even be talking about the crisis in the Middle East. We'll be talking about how wide open financial markets are, how much deal making will be getting done. I can't remember the full list from Jim, but it went something like that. Do you agree with that?
I 100% agree with that. And again, I do think you've got a regulatory construct, you've got the SEC, you've got the FTC, the DOJ, you've got all these, regulators in Washington that are primed to want to help the growth in this economy.
Do you think that in this environment it's appropriate for the government to take a stake in, say, a struggling airline operator like Spirit, given the fact that most people are saying this is a short-term issue that you can look through?
Well, look, there's a difference between what this administration has implemented as policy on critical sectors. Critical sectors, whether they be those that are central to the discussions with China. How do we go make our supply chain secure? How do we make sure we have a biopharma supply chain here so the next time we've got a shortage or a pandemic, we're not relying on China for inputs for our drugs? I do think that there is almost a bipartisan recognition that, hey, we got to do that. I'm not so sure that there is a bipartisan recognition that, hey, we've got to step in and help whatever domestic industry there is. And, we'll have to see whether these discussions come to fruition and what the reasoning is behind it.
Eric, what happened to the Republican Party? Come on.
Well, listen, right now, Jonathan, it's not a good topic with me because I just experienced in my state of Virginia a very, very narrow loss in a very extreme partisan gerrymandering that the other side put into place. And I do think people are going to have a reaction, and there will be a backlash to some of the extremity that's going on.
You think that'll show up in the midterms?
Well, I hope so, because there was no question where the intensity was on the part of the two sides in Virginia on Tuesday. They were on my side because of the extremity and the just insane, there's no other word for it.
Aren't both parties guilty of that? Why was this different in Virginia?
Well, this one in Virginia, you have to get granular and specific, but it was 36 changes to the law. There was a waiver of the Constitution just for 5 years so that they could go against Trump and respond to his alleged moves. I mean, these things, most people are not living that partisan lens. And I do think ultimately people are going to be worried about how they get ahead in their life. And I think this discussion about prices and gas pump prices, that's what is going to ultimately determine all of this, as well as the outcome in the midterms, is are we going to get these prices at the pump down?
Eric, it's good to see you. It's good to catch up.
Pleasure.
Thank you, sir, as always. Eric Cantor there of Moelis and Campmany with an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn is back with more. Hey, Vonnie.
Hey, John, thank you. The U.S. military intercepting 2 Iranian oil supertankers that were attempting to evade its blockade. U.S. Central Command saying the tankers are now anchored at an Iranian port in the Gulf of Oman. CENTCOM saying the U.S. has directed 29 vessels to turn around or return to port since the blockade began. Italy could make an appearance in the upcoming World Cup. The Financial Times reporting a top envoy to President Donald Trump asking FIFA to replace Iran with Italy, arguing Italy's 4 World Cup titles justify awarding it the slot. The Senate taking the first step, reopening the Department of Homeland Security. Republicans approving a $70 billion budget plan to fund ICE and Border Patrol through a process that requires no Democratic votes. The bill now heads to the House. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes. Up next, the Morning Calls Plus, Chris Caso of Wolfe Research on the record-breaking run for chip stocks from New York City this morning. Good morning.
In the short term, you have flow of funds, maybe people raising capital from selling Tesla to buy SpaceX. The two companies combined together can help get that scale needed to run in this CapEx AI race that Elon is certainly part of right now. For patient investors, it is a way to invest in ultimately what we think is going to be a combined company.
That was Ben Kallo of Baird. Great conversation. Exchange on Tesla there. This equity market erasing this morning's losses. The equity market so far insulated by the tech boom and insulated by decent numbers from corporate America so far. Equity futures negative by just 0.1%. See a similar story in the bond market as well. Yields now just about unchanged on the session. They were higher, the 10-year at 4.30. See the same thing in crude. Crude really setting the tone for the market this morning. Crude was higher, now lower on the session by 0.4%. 92 on WTI. Brent crude at 101. That's the cross-asset story. Let's get you some morning calls. First up, Morgan Stanley reiterating its equal weight rating on Tesla, noting limited near-term upside. Your second call from Guggenheim, raising its price target on GE Vernova. What a story. Citing strong order activity. That name is up at a pre-market by 1%. And finally, Barclays upgrading Texas Instruments to equal weight, calling industrial exposure the, quote, place to be in analog. Let's talk about the semis. The Philadelphia Semiconductor Index hitting fresh all-time highs with a record-setting 16-day rally. Chris Caso of Wolfe Research joins us now for more. Chris, welcome back to the program. Since the end of March, that index has not looked back. What's driving it?
Well, what's really driving it is some of the news that preceded the rally, and the things sounded very good after January earnings season, particularly in AI. You had good news from Broadcom in terms of their visibility all the way into next year. AMD picked up some new business in their AI business. Nvidia had their investor conference, their developer conference in March, which was very bullish. And the interesting thing is, you talk to investors at the time, the stocks weren't moving. And the question was, why? Is the AI trade over? And then all of a sudden, 16 days ago, everything started to move. But there wasn't particular information 16 days ago. It was just reacting to what was already out in the marketplace.
Chris, we did get some headlines from the likes of Anthropic. Mythos is so powerful, it's dangerous, those kind of things. Does that help things?
Well, listen, we're in the experimentations phase of AI right now. What's really interesting and important is agentic AI. Where's that going to go? How is that going to drive the need for tokens? But what seems very clear right now is that there has to be a lot of spending. And, I would say the pushback for everything AI now, and that's certainly what's driving semis, is that are these companies, are the customers, the Googles and Anthropics and OpenAI, going to be able to spend enough, to kind of keep numbers moving higher? And our view is, I don't see how they can't, because this is so transformative that if you are not spending right now, you're going to be left behind, and no one wants to be left behind.
Chris, one of the constraints perhaps maybe is just simply the sheer supply that these companies can produce of semiconductors to fuel demand. How concerned are you in earnings reports that we get some insight into what the Iran war might be doing in terms of key resources needed in production of some of these components?
Yeah, so the war itself and the issues in the Middle East are not an area of concern. There were earlier some concerns about, for example, helium supply, but we've done a lot of work on that, and I think the consensus is that's not an issue. But there are real constraints. And, for example, right now, memory is one of the main areas of constraint right now, because there's not enough physical clean room space to put the tools in place to build all the memory we need for AI. It's similar with TSMC. TSMC last Thursday, their CEO said it takes 2 to 3 years to build a new fab, 1 to 2 years to ramp it up. And in his words, there are no shortcuts. But ultimately, I think that's a good thing. And, it will cap the eventual where numbers can go in 26, 27, because we're tight at capacity. Power availability for AI is also another constraint. But this is a long-term dynamic. And, months ago, the big concern was that we wouldn't have enough demand. Now, if we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. And of course, one of the other concerns is, are we in a bubble? We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
There's also an issue about how much some of these companies can charge. TSMC said that the latest ASML chip-making gear is too expensive for them to use. I mean, are you hearing this in other capacities also pushback, saying ultimately there are certain levels at which we will just not buy, that is constraining the ability to just simply keep jacking up the cost?
Well, that particular comment is pretty specific to ASML and its next generation equipment. And ASML is the only company that you could buy lithography equipment from right now. So they have a very strong market position. They're flexing that position. TSMC is also really the only place you can go right now for advanced logic. So they're also flexing their market position. So I think what you're hearing in that is a bit of a negotiation between parties that's happening publicly. But the fact of the matter is, it's very expensive to build semiconductors right now. But that's the good news in AI, is that, the past couple of years, we're depending on handsets and PCs. They weren't generating enough profitability, enough reason to go to the next node. That's the good thing about AI. It needs a lot of performance. And what it seems like is their customers, the end customers, the OpenAIs and Anthropics, are getting paid for that performance right now. And we think that's just bullish for the group in general.
Chris, next week we heard from the big spenders, the big tech players on Wednesday, the big customers of the companies that you cover. It's important to track the tolerance of investors in the stocks of their biggest customers. The tolerance that we're starting to gauge is maybe changing, turning just a touch, just a little bit. Chris, Lisa mentioned this with regards to Tesla earlier. They lifted their capex, the market pushed back. Are we reaching the limits of how far some of the biggest customers of these chip players can push things?
Yeah, and I don't cover those companies, so I won't comment on what it is for those particular companies. But it is a question of investors. Is if those hyperscalers, if the investors won't tolerate diminished free cash flow in the near term in order to support these investments, will the investments happen? And our view is that whatever happens to the hyperscaler stocks, whatever the investors' tolerance is, I don't think they have a choice right now. It's a little bit of a prisoner's dilemma right now. If Google spends and Microsoft doesn't spend, Microsoft's just going to get left behind. And I also think those investors are not going to tolerate anyone waving the white flag right now and saying, you know what, we just don't have confidence in this AI investment. We're not going to do it. If you do that, then you're missing, the biggest technological revolution in a long time. So I think you have no choice but to spend, regardless of what your investors feel right now.
That's a pretty powerful bull case for the names you do actually cover. Chris, I appreciate your time, sir. Chris Caso there of Wolfe Research. Stuck between a rock and a hard place if you're the big spenders right now.
Which is a reason why they're continuing to spend, and it seems like it's an existential risk. You just wonder, if you're in an existential moment, you're bound to overpay. You're bound to waste money.
Yeah.
Because you don't have a full understanding of exactly how it's going to get deployed, how it's going to get monetized, how it's going to be expressed going forward. There are going to be losses ahead. And this is what the market is sussing out right now. How do we avoid being and bearing the brunt of those losses? Is it going to come from the equity investors? Is it going to come from the bond investors that are fueling this? Or is it going to come somewhere else in the hands of all of us paying higher bills? I don't know the answer, but that is, I think, part of what's generating some of the anxiety.
When you believe, with high conviction, the biggest risk right now is underinvesting and not overinvesting, then the odds are rising for a major misallocation of resources. That concerns a lot of people. With the semi-rally we've seen, Chris brought up a really interesting point. I think he's absolutely right. It was really odd that after the last earnings season, we went through all those numbers, that $600 billion plus of capex from a handful of tech firms, and yet we didn't see the semis rally off the back of it. It was really odd. They didn't do much at all. Then the last 16 days, the reset we've seen through this war and this powerful rally in chips has been more than just tremendously phenomenal.
For people who don't want to just keep watching the headlines, they go back to their old notes and they pulled out the one with the semiconductors and the spending plans, and they said, aha, eureka. And
Tech leadership is back.
Exactly.
Back in a big way. Next on the programme, the latest jobs data set to cross initial jobless claims just around the corner. Reaction from Nela Richardson of ADP. Live from New York City, welcome to the programme. Seconds away from economic data, jobless claims just around the corner. 60 minutes away from the opening bell. Equity futures look like this. A raise in this morning's losses, unchanged on the Russell now. On the S&P 500, negative by not even 0.2%. In the bond market, yields were higher, tracking crude. Now they're lower. At the front end, at least unchanged. 380, 379, 78, and just about unchanged on 10s as well. 430, 55. With that economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Well, we've got a slight rise in jobless claims, up to 214,000 from a revised 208,000. Not a big change, doesn't signal anything major happening in the economy. On a continuing basis, claims are at 1,821,000. That's up from 1,809 the 2 weeks before. So at this point, it's still kind of the same story that we have been seeing. The companies out there are on hold. They're not laying off people in great numbers, but they're not hiring either. It'll be interesting to see what the war effect is when we get the April jobs numbers coming up in May.
At 8:30 on Thursday mornings, Mike, I'm just going to clip this and then keep playing it out next week and the week after.
So I could take Thursday off.
You can, Mike. Your analysis will still work as well. Thursday morning at 8:30 Eastern Time, it's almost exactly the same. It's low hire, low fire. If you're out of work right now, it's difficult to get another job. You see that in continuing claims. Low fire, you see that in jobless claims. 4-week average around 210 this morning. 4-week average around 210. Phenomenally low initial jobless claims, and we talk about the same thing every single Thursday morning and have done now for months on months on months.
People used to say this was the best real-time indicator of the labor market that you could potentially have, and right now it's essentially flatlining as any kind of indicator whatsoever because it's not doing anything. It's essentially staying in the exact same place. So is it losing relevance, or does it just highlight that this is a labor market that just isn't doing anything, that it's almost flatlined in terms of its progression in one way or another?
Mike, how relevant was that to Kevin Walsh's testimony earlier this week, where he seemed to spend way more time on one side of the mandate versus the other.
Almost all of his time was spent on inflation and very little about jobs. And what was discussed on jobs was the Fed's previous idea of inclusion in the labor market and how that didn't work out because it created more inflation. So it's going to be interesting to see what Kevin Walsh starts to say about the labor market when he gets into office at whatever point that is. But for right now, it doesn't seem to be a major concern, and it hasn't been for the Fed for the last couple of weeks. Interesting point. The economists over at Citi point out that in the last 2 years, we have seen rising claims as we get into May, which they're attributing to seasonal effects. So we might get some change coming up in the next few weeks. It's something to keep an eye on, but whether it's meaningful or not, they don't reach a conclusion.
Hours worked in the next jobs report might be lower. Mike McKee on a 4-day week from now. Mike McKee, thank you, sir. Appreciate it. Thank you very much. We see it every week, every Thursday morning, 8:30 Eastern Time.
I mean, it's just shocking. We were talking about predictions ahead of this, and it was not necessarily like 190 to 250, but is it going to be 209? Is it going to be 210?
Right.
211?
I mean, I'll take it. It's good news.
It's
good news.
Wonderful news, but is it news? And is a lack of news good news in the sense that if we're not seeing any kind of evolution of a jobs market that is pretty stagnant, is that a good thing or a bad thing?
With us around the table, Nela Richardson of ADP. Nela, good to see you. Unchanged at the surface, at the headline level, how dynamic is this labour market beneath the surface?
So on Tuesday, ADP Research put out their weekly national employment report showing an average over the last 4 weeks of 54,750 jobs. Maybe it was 250, around 54,000 jobs. And that was the fifth, now this is the number I know, the fifth straight week of strengthening. What that means is that I think you're going to pull over into a different dynamic in the labor market this spring, where it's a low fire, some higher, maybe strong higher month in April. That is what the data is looking like right now, and that is our earliest indication of how this labor market is actually strengthening over the last 2 months. I know it's a surprise.
Amazing.
But the small firms are leading the way. We are seeing consistent strength in firms with employees that are less than 20 in count. So we are seeing the small firm engine starting to drive through the geopolitical uncertainty.
54,750, just to confirm.
Thank you.
You basically said it anyway.
I didn't have enough coffee this morning. It was too much traffic. But.
Clearly not. Still early. Let's get into this then. Where are the gains coming from? This is important because when we get the payrolls report, usually we're talking about a lack of breadth. It's just healthcare, healthcare, healthcare. You see more than that now. Are things changing?
We're seeing healthcare, but we're also seeing small firms driving that as well. And we're seeing it in construction as well. That's important in terms of the infrastructure and the build that's required for a lot of the AI infrastructure with data centers. So we are seeing some pickup in some places that are important to the economy, but it's not as widespread as we would like. It's concentrated. Now, given the strength of what we're seeing in early April, that could change for the month. We need Mike McKee back on that Friday because you might start seeing these industries that have been slow, have been stagnant, start to pick up their hiring this spring. That's what I'll be looking for.
How much do you think that the uncertainty around the Middle East and oil prices could crimp that? Or does this feel independent because it is in sectors that are tied to the AI CapEx in the construction areas in particular?
Yeah, it does feel somewhat independent. These firms, for one, are not price makers in the market. They're price takers. And they've been taking this price for a long time in terms of higher energy costs and the effects of inflation in a lot of their input prices, mainly due to tariffs. And whether we look through, whether it's geopolitical uncertainty or tariff uncertainty, small firms can't look through their here and now. They are on the main street. They are doing the groundwork. And when they see the customer demand and know that they need to hire after not hiring late last year, they have to actually meet the customer. And that's why I think we're seeing hiring now, because they've delayed for so long, they can't not and grow their businesses and sustain their businesses.
We've seen job switchers not see as big of a pay raise as job stayers in some capacities, or at least not see as big of a gap as they have in the past. Do you expect that to change just because this demand is increasing to such a degree?
We've already seen it change, actually. With our March report, we saw a pickup in job changer salaries from 6.3 to 6.6% in March. Again, with this strong number, I think it picks up even more. So yeah, the difference between a job stayer pay gain and a job changer pay gain has shrunk tremendously over the last few years, but it's not at its low, and it's starting to widen. Now, what does that mean in the short term? We're seeing strength. We're actually seeing a healthy labor market, though fragmented, though concentrated. What that means for the summer, I can't tell you, because it's going to depend on whether or not this is sustainable or just a blip. Is this kind of small firms being opportunistic, hiring while they can, or is it this longer sustained trend built on customer demand? That is an open question.
That is some good news. The money's coming back, the wages are coming back, the leverage coming back, just a little bit, the pendulum swinging back to the employee.
Yeah, especially because the employee is looking at the higher costs as well and saying, well, if I'm going to go back into the workforce, I'm going to have to pay that. If you start to see wages pick up in job switchers, great news for the employee. A question about the pass-through with inflation, given the fact that some of the unmitigatable costs are going up in a sustained way. So this kind of goes back to the question of what do you do with policy? What does this tell you about where inflation really is?
Nela, this is the ultimate counterpoint to 2022. Labour market's not as tight. Consumer price tolerance not as high. You're not going to see inflation pick up in the same way off the back of this energy shock. Do you agree with that?
No. I think inflation is a really careful watch point. I wouldn't dismiss it. I think it's important for us to keep it front and center. I also think that we are all talking about AI and the impact of AI as part of that inflation reducing mechanism. I'd be careful and cautious there too, because AI is a very resource intensive tool. It takes water, electricity, new data centers, and all of that costs a lot of money to run these tokens on a periodic basis. So we have to be careful how this new technology actually seeps in to inflation, into the larger economy.
Is that a sequencing problem? Is that an upfront cost, and then over time you get the decline in prices over time? How do you see things?
Let's hope. But, the important part of tech is that it's always growing, and it's always growing at a faster rate. And so our resources do not grow at an accelerated rate. They grow slowly. And so tech demands and resource constraints will one day meet an economic reality that pushes inflation higher. What we're not seeing, though, is this erosion of the knowledge worker. And I wrote about this week. In fact, when it comes to knowledge work, especially those tied to what are traditional occupations, lawyers, doctors, computer scientists, we're actually not seeing them go away. They're actually increasing as a share of employment. What has gone away is office work tied to the actual location. Think your office manager, your janitorial staff, your clerical staff, those positions are declining, but those don't make headline news. So knowledge work, I think, is here to stay, but we have to be careful of inflation.
And this is the argument that Fed Chair nominee Kevin Walsh was making. Didn't hear much of it in the hearing, but ultimately the argument he's making is that AI is going to lead to a broad-based decline in prices and leave the door open for interest rate reductions.
And it's a highly controversial point, as you're just hearing here, because ultimately it is resource intensive and people are pointing to the CapEx and how much it's increasing costs in the short term. You asked the key question, John. Is this a sequencing issue, or is this going to be permanently higher costs on the input side or that offset some of the efficiencies that you get on the worker side?
Nela, good to see you. Thanks for breaking it down. Smart stuff as always. Nela Richardson there of ADP with a cautious note on inflation and a confident note, constructive note on the labour market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. So recapping the data we just got, jobless claims for last week coming in at 214,000, a slight tick up from the previous week and a nudge above estimates. Continuing claims also rising by about 3,000 from the week prior, indicating the economy is holding on to its low hire, low fire environment. White House National Economic Council Director Kevin Hassett showing support for Fed Chair Jay Powell. Hassett saying Powell should remain at the helm of the central bank on a temporary basis if a successor is not confirmed when Powell's term expires next month. The Trump administration is nearing a $500 million bailout for Spirit Airlines. Sources telling us here at Bloomberg the deal would give the U.S. government the option to take ownership of up to 90% of the carrier once it emerges from bankruptcy. United Airlines CEO Scott Kirby discussed the deal with our Lisa Abramowicz.
This was a fundamentally flawed business model that I've been on going back into the last administration saying it's going to fail because the business model doesn't work. And so I think the spike in fuel prices just moves it forward by a couple of months.
Kirby sidestepped questions about a potential merger with American, but acknowledged that the current climate might offer opportunities for deals. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate the update. There's been some obvious pushback to that story. Let the market do its thing. Let the market work.
Yeah, and you have questions about why Spirit was not allowed to merge with JetBlue a couple of years ago, and then if it was looking to merge a couple of years ago, and now it might not survive. Is this a good use of U.S. funding? This will be an ongoing question.
Rightly, there was criticism under the Biden administration about not letting that deal go ahead, and rightly now there is criticism of intervening in the market when the business model is clearly failing.
We've had consecutive administrations that have taken a role in exactly the way they're taking stakes or putting their thumb on the scale when it comes to certain corporate actions. And there will be a real kind of reckoning about that in markets. And I think people are struggling with that, as I'm struggling to express.
The new normal
Yes,
down in
exactly.
Washington, D.C. Yeah.
That's correct.
Up next on the programme, Nisha Patel of Parametric, looking ahead to next week's Fed meeting. Plus, your hire is going to be back. She's got your morning movers going into the opening bell. Another check on IBM shares sinking on AI software concerns. That name down in the pre-market by close to 8%.
With this technological revolution that we're experiencing, with the AI boom, companies are thinking, how am I going to position myself? Boards and management are saying, hey, what do we have to do to take advantage of this? And you've got that tailwind that continues to push forward in terms of people saying, hey, maybe we should transact. Maybe we should accomplish more scale in order to take advantage of this situation.
So that was Eric Cantor of Moelis and Campmany on the programme a little bit earlier. An aggressive forward-looking mindset dominating this market, keeping equities close to record highs, just pulling back from those levels this morning by 0.3% on the S&P 500. Similar move on the Nasdaq. In the commodity market, interesting morning so far. Let's check it out. Brent and WTI. Positive now by, let's call it 0.6%, in at around 102.50 on Brent crude. The Washington Post reported this coming into today's session, that it could take 6 months to fully clear the Strait of Hormuz of mines deployed by the Iranian military. The president out on social media just moments ago saying the following: I've ordered the United States Navy to shoot and kill any boat, small boats, though they may be, that is putting mines in the waters of the Strait of Hormuz. There is to be no hesitation. Additionally, our minesweepers are clearing the strait right now. I'm hereby ordering the activity to continue, but at a tripled up level. Thank you for your attention to that matter. Statement from the president just moments ago.
Yeah, and this is adding a little bit of a premium to the oil trade, especially given the fact that there is an accusation of potentially or an order to shoot on any ship that is suspected of laying any mines. This goes, though, to the Washington Post report, and it kind of edifies it, frankly, that a number of different intelligence sources said it would take 6 months to clear any of those mines that had been laid by the Iranian forces. Again, going back to a question, how soon can we open the Strait of Hormuz in a real way that is anything like what we've seen before this conflict started?
It's so complex, so difficult. That's why so many people in this equity market have moved on and are clinging to other forces, like the numbers we've seen from tech and from the premium consumer. You've talked about this a few times already this morning. The pillars of support for the US equity market at the moment: one, a tech boom. We've seen that in several companies so far this week. And two, the premium consumer, that even with these higher costs for the airlines is driving demand. And you saw that again in American Express earlier on this morning, better than expected.
They can continue to spend, which is a reason why you've seen even prices maintain at their levels. The fact that we heard from United Airlines that they were surprised at how little demand destruction there actually was, given the fact that they had raised prices, shows the strength under the hood. And then Nela Richardson coming on just moments ago saying, actually, the labor market is turning up and people are getting jobs and a lot of employers are now paying up to get them. It kind of speaks to that that resilience and that strength.
That's the support. That's the tailwind for the market. The headwind, just to go over that headline again, the president ordering the Navy to shoot boats, placing mines in the Strait of Hormuz. We've got a ceasefire, but it's a fragile one. And I think that headline, that statement, speaks to that. As we count you down to the opening bell, 41 minutes away, let's get you some single names for morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing a big sudden drop in super microcomputer shares, down nearly 11% in the pre-market. After a Bluefin research report unveiled, it lost a massive contract with Oracle worth up to $1.4 billion. And they're saying that may be tied to the co-founder's indictment, who, if you remember, back in March was accused of illegally diverting billions of dollars of NVIDIA servers to China. Moving on to IBM, those shares also falling in the pre-market, down 7.7%. Earnings were solid, but not enough to ease Wall Street's biggest concern, which is, of course, AI disruption. Software revenue up 11%, but that was only in line with estimates. And ending on a good note with Texas Instruments surging nearly 10% now in the pre-market after crushing estimates. They make the power and analog chips that keep data centers humming, and that demand is driving all the upside. John?
Stock is flying by 9.8% this morning. Yahara, thank you. Thanks for this morning. As we count you down to the opening bell, sneak peek of the next 24 hours and the next week for that matter. Later this morning, we'll get you some PMI data as well as Intel earnings after the close. Friday, UMich consumer sentiment. On to next week. Next week is basically about one day. Or at least on the schedule, it's basically about one day. On Wednesday, you get a Fed rate decision and earnings from Alphabet, Microsoft, Meta, and more. It is the biggest week of earnings on the calendar.
Yeah, and it's going to be the key pillar for a support, potentially or not, for this equity market, given that has been the support that people are looking at. Is the AI hopes and dreams? How far can they go?
Looking ahead to next week's FOMC meeting, Nisha Patel of Parametric writing the following: the Fed is patient, not panicked. My base case is still another hold. Nisha joins us now for more. Nisha, good morning.
Good morning.
Does that hold go to the next month, the month after that, and potentially through the rest of this year?
I think there's a good chance that now we're looking at a 2026 with where we could see no rate cuts, right? Unless we see a very different story transpire. And the biggest kind of caveat being that, does demand destruction, right, lead to lower consumption spending? Does that start then bleeding into slower growth, right? And an alternate story in the jobs market, labor market, which is the opposite of what we're seeing this morning, kind of that continued strength. So outside of that change, very strong earnings, as we're speaking about, a resilient economy, almost a little bit of hiring back into the labor market. It is going to be, I think, very tough for the Fed to change their stance and really justify a rate cut given where we are. Now, I would say it's not maybe about if there's any cuts. This could just be possibly pushed back to maybe 2027, right? Time will tell a lot of how long kind of this war I don't want to say drags on, and higher oil prices will really be an indicator of that.
It's one thing to look at the reaction function of a Federal Reserve. It's another to look at a reaction function of a market. If the Fed were to lower rates, saying that AI is going to cause efficiencies that will be disinflationary down the line, would your reaction be to sell the 10-year?
I would say so, because at first instance, right, it would be very preemptive to, let's say, the market to truly believe. Now, I would even think that for the Fed to cut rates just on the thesis that AI is going to lead to productivity gains, right? This is going to take some time to actually permeate in the market. Now, if the Fed were to make a credible argument, really support that, say we are going to preemptively cut, I think you could see a market reaction where there's going to be some doubt, right? Without that actually coming through in data, without that being actually solidified, there could be a short-term reaction there of, hey, is there a reason or really justified cuts without actually seeing this? Now, that may actually transpire, but I think this is more of a medium-term story rather than assuming that productivity gains, right, are going to come about without actually seeing that in the data.
Everything that we've been talking about this morning, whether it's the commodity story or if it's the earnings story, and you put those two things together, is inflationary.
Yeah.
Do you think that this market has reflected a true concern about inflation, or are we just measuring it wrong? And actually, if you look at it, it's actually quite low.
So I think we're seeing that, look, if you look at fixed income, if you look at overall rates, right, we're seeing this built into especially the long end of the curve. But I still think that the market is telling you, look, this is still maybe a transitory story, right? This is not going to necessarily be sticky inflation. Market, in some sense, is willing to look through this. Now, I still go back to, At what point, right, all this inflation shock recently has come from higher oil prices. At what point do you start hitting a tipping point where that could actually be disinflationary because you start seeing a pullback in demand? So I think we have some of this priced in. I think we haven't really seen maybe kind of all of it fully priced in just yet, which is why, look, in fixed income, I think there's tactical ways to take exposure, right? I think the biggest stories of fixed income managers today, we've had a few guests here on the show, absolute yields are still attractive, right? We're not saying you have to necessarily reach for duration. But the story here is like you have income. You're no longer banking on rate cuts for total return in a fixed income portfolio. That's the biggest change that we have seen over the past few years. So I think kind of that fixed income story is back, taking some of that exposure, adding a little bit of duration in the short to intermediate part of the curve is a good way to do that.
Nisha, very quickly, 30 seconds. If the US Navy starts hitting and striking boats laying mines in the Strait of Hormuz, would you consider that a resumption of hostilities and the end of the ceasefire?
I would. And I think that is going to create a significant reaction in the market, right? And I don't even say renewed, increased geopolitical concerns. I mean, you could see a significant flight to quality in that scenario. So I think we're still teetering on, obviously, economic data being a very key component. We had a big number today, having that coming up, Fed meeting, but we cannot separate out the geopolitical risk, right, and that flight to quality that we could see as a result of that.
Nisha, appreciate your time. Thank you. Nisha Patel there of Parametric. It's a fragile truce. A fragile truce.
Yeah, we're seeing the sort of armies line up on both sides, ready to call an end to that truce.
Up next, we'll catch up with a man who's got a good read on what's happening militarily and in the markets. We'll speak to Peter Cheer tomorrow of Academy Securities, Kay Herr of JP Morgan, Sarah Hunt of Alpine Saxon Woods, Bob McNally of Rapid Energy. Looking forward to being with you tomorrow morning from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.